tomorrow's New Hampshire primary. We're going to break down what another Republican administration could mean for markets.
Well, happy Monday, everyone. Let's get a check of the markets here. We're about 30 minutes outside of the start of today's trading session. You're taking a look at the Dow, the S&P 500, and the Nasdaq futures. They are higher across the board. Fractional gains for the Dow by about 0.3%, S&P 500 0.3% there, and the Nasdaq futures, the tech-heavy average, up by about 0.5%. Let's also take a look at some Treasury yields here as well. You've got the 5, the 10, and the 30-year all down right now by a little more than 1%. The 5-year down by about 1.5%, 10-year about the same there, and then 1.25% in decline for the 30-year. That's just sitting at about 4.3 as of this point in time.
And we have some big trending tickers in the pipeline. Boeing shares sliding over more FAA scrutiny. The agency telling operators of a second Boeing model to inspect its door plugs. And shares of Archer Daniels Midland ADM are plummeting today after cutting its earnings outlook amid an investigation into the company's accounting practices. Now, the company's CFO has also been placed on leave. And SolarEdge is rising today after announcing layoffs amid broader slowing demand across the sector. We are going to be taking a deeper dive into each of these stocks in just a few minutes. But first, let's start with the massive momentum that we have seen in the markets as of late, because stocks are on track for another record high at the open as AI euphoria fuels recent gains. Solid results from Taiwan Semiconductors last week set the tone for chip makers. The iShares Semiconductor ETF coming off an 8% gain. And this week, we'll hear from Netflix, Tesla, and Intel, all set to release their quarterly results. Is there one report that could make or break the market's momentum? Well, joining us now is Bob O'Donnell, Technalysis Research LLC President and Chief Analyst. Bob, it's great to have you here. So put this all in perspective for us. We certainly have a lot of optimism heading into this week. Is there one earnings report that you see on deck for tech that could really make or break the recent gains that we've seen?
Well, hey, Shauna, thanks for having me. I don't know that there's a single one, because the beauty of the momentum that we're seeing around AI is the fact that it is relatively spread out. Obviously, NVIDIA is the one case that everybody tends to point to, but I mean, look what we saw with Microsoft overtaking Apple, right? We've seen a lot of growth from other players, AMD as well as another big chip supplier. As you said, TSMC, ASML, they're one of the chip equipment manufacturing makers. Other companies who've been involved with generative AI related software. We've got Google, we've got Meta, there's Adobe. I mean, all of these types of companies, I think, are poised to benefit, because why I think the momentum is happening is that a lot of people are starting to expect and see that 2024 is the year when it actually starts to hit the mainstream, when average people in their jobs and in their various environments are going to start to see some of the productivity benefits from AI. And then the hope, of course, is that translates in turn to reduce costs. Now, the specter of concern is that, does that also mean, people, companies can do more with less people, and will that lead to layoffs? That is an overhanging cloud that, certainly some people are concerned about. But I would say in general, this is a pretty broad-based level of interest. And so that's why it's hard to kind of say, it's just going to be this company or that company, because there's going to be a couple that may not do as well. Particularly, there's a couple of tech stops on the hardware side that we know that Q4 was sort of the bottom for a number of companies. So those Q4 numbers may not be great. Obviously, it's going to be their outlook looking ahead. I think generally those are going to be pretty positive.
And so a lot of investors out there perhaps wondering if they've missed out on the big leg higher in AI from 2023, and if there is yet another leg from here, from this point. What would you need to hear from these companies to firmly signal that there is that next inflection point?
It's a great point, Brad. And I think a lot of people are going to be concerned with that because how long can this go on, right? There's always that question. Look, obviously, it's going to boil down to what their expectations are for, and the pipelines. If we start hearing about really long pipelines for earnings and demand, I mean, that's why, NVIDIA, they can't make enough chips, to satisfy the demand. They're a classic example.
Jensen Huang's making them in his kitchen, Bob, from what we saw. He posted that photo.
Yeah, exactly. I mean, the bottom line is, I think we'll start to see a few other companies besides NVIDIA start to talk about some of that pipeline type of business. And again, it's going to be broad based, because the thing about AI is obviously you've got the chips that drive it, you've got the software and services that enable it, and there's companies who also do the implementation services, and that's pretty broad based. You've also got people like selling the traditional server hardware into companies. Companies are starting to do some of this AI work on their own. And then all the smaller companies that are kind of feeding into this, the open AIs that are helping, with Microsoft, the Anthropics that are helping with Amazon. They're all of these smaller companies that, of course, may see as purchase targets in the new year as well, because a lot of people are also talking about acquisitions for AI in 2024. But, I think specifically to your question, Brad, I think it's going to be all about what sort of pipelines are they seeing, and are they able to maintain those pipelines, and what sort of vision do they have? Are they willing to even go out more than a quarter and maybe start talking about what their expectations are for the full year?
So, Bob, given that and a number of the long list of questions that investors need to keep in mind this earnings season, who do you think then is best positioned at this point heading into these these results that we'll get over the next several weeks?
Well, I mean, look, it's going to vary a lot. You specifically brought Netflix. I mean, Netflix is a different animal, right? I mean, it's a movie entertainment streaming service. It happens to be delivered via tech, but come on, it's not really a tech company. But look, I think Netflix looks great. Not necessarily on the AI side, although they use a little bit of AI to determine what things you might want to watch next, but they've been doing that for a while. But I think they're going to benefit from some of the password sharing stuff that they've done, their advertising offering, especially in other countries outside the U.S. where they're really seeing a lot of growth. But in terms of actual tech, I mean, I'm going to be watching all the big tech chip guys. Intel is later this week. Again, it will be interesting to see what happens with Intel. IBM is later this week. IBM has been building up their AI business as well. Tesla obviously is going to be interesting to watch. But again, I think it's more on the pure automotive side. The AI things that they're doing. I mean, look, you've got Musk saying, "Oh, well, I won't do more AI stuff within Tesla unless you give me more money." I mean, that's going to cloud things around a bit for them on the AI side. So it's going to boil down to, hey, what kind of demand does there continue to be for EVs and the car segment in general, and EVs in general? So again, I think it's broad based. I'm still excited, obviously, about NVIDIA. I still think Microsoft has a big run. I'm going to be curious to see what Google's able to do as well, because I think there's a lot of opportunity there.
All right, Bob, I told you that next time we had you on, we'd just play some guitar and jam out a little bit. Too many earnings to jam on, though, to begin this week here. Bob, we appreciate you helping us break this down and ahead of the market session beginning here. Bob O'Donnell, Technalysis Research President and Chief Analyst. And another top story that we've been watching today, the battle over America's favorite department store continues. Macy's announcing Sunday night that it rejected a $5.8 billion takeover offer from private equity firms Arkhouse Management and Brigade Capital Management, saying the deal has a, quote, lack of compelling value. This comes after Macy's said that it's cutting over 2,000 jobs, closing 5 department stores. So what's next for the troubled retailer? We have Jan Kniffen, who is the J. Rogers Kniffen Worldwide CEO, and our very own Brooke DePalma here. Jan, I want to begin with you as we continue to think about what plays out from this point and what Macy's needs to do to ensure that it has enough liquidity, has enough capital for whatever that framework and the structure that it looks like it needs to operate going forward is.
Well, Macy's itself is in fine shape as far as operating and going forward. The stock's not trading at the level they would like to see it trade at, I'm sure, but they're well capitalized, no issues as far as running the business. Tony Spring has taken over from Jeff Gannett. Adrian Mitchell will still be there, who's really done a lot to get Macy's on the right track. They're doing the right things, right? They're building smaller stores. They're exiting some of the less productive stores. They're cutting expense structure. They're building a 3PL operation. They're doing advertising, media, the things that all the retailers are moving toward to make more money. On the other hand, now they have a big bid on the table. And they basically said, well, $21 isn't enough, and we don't think your bid's financeable anyway. So the question is, does the other side come back and offer more? Does someone else come in and offer more? And is there someone that can offer a better financing opportunity? Because one of the complaints here was, when you're all done, you're only going to put 25% of the equity in. All the rest is going to be borrowed. We're going to be way too levered. And we know what leverage does in retail companies. It's very destructive to retail companies. Macy's, and remember, when they were federated, has been through bankruptcy before. They have seen this movie, and they didn't like it.
It certainly is true, and you can make that case about a number of retailers who have struggled in the past. Jan, Brooke, let me bring you into the conversation, going off of what Jan was just discussing about what happens now, breaking down those potential options at this point, and also the possibility that we could see Arkhouse do a bit of a workaround and look to appeal directly to shareholders.
Yeah, important to note here that the window for shareholder nominations for Macy's did open on Saturday and closes on February 19th. And so it's important to watch how Arkhouse takes that into consideration. But really what we're looking at here, as Jan was emphasizing, is this turnaround effort that Macy's has been making to close stores, to open smaller formats, and launch new in-house brands. It really is in the midst of that turnaround brand, but you can't help but notice that this is the tale of two different players coming into the game looking for two different things. Now, Arkhouse says that they have intentions to use Macy's runway that it's currently on, while Macy's largely thinking here that this could be a real estate play. They think that their business is still profitable, that it's worth a bit more than this, but you can't help but think of that Herald Square store right there that's worth billions of dollars, and Macy's not too eager to give up that real estate portfolio too soon. But unless Arkhouse really sweetens the pot significantly, Macy's not really looking at a quick solution here, not really eager to sell out too soon too.
Yeah, that's a great point. Jan, what are some of the wholesale partners that Macy's works with? What are they to think as all of this plays out?
Well, they'll be very concerned, of course, but their concern is that does Macy's continue as an ongoing operating company that continues to do what it's been doing? Because they'll continue to sell to Macy's. That's not going to be the issue. And they want to make sure there's plenty of stores there to drive that product out because they've had relationships with Macy's forever. So I'm sure they're watching it very carefully. What they wouldn't want to see is a Sears event, right? It gets bought out and then everything goes away. They don't want to see that. They don't have other places to go with it. Remember, Macy's is pretty much last man standing. Dillard's is the only other player of size in the space, and they're a third the size of Macy's. So it's still very important to the structure of all of the vendors that Macy's is around and continues to do what they're doing. Back on the other subject, we do think that the real estate has a market value of $8.5 billion, and that's basically what's on the table. These guys have ponied up equity, theoretically, plus the debt they would assume, and the total together is about $8.6 billion. So it kind of means the rest of Macy's comes as a gift with purchase if you really believe that the real estate itself is worth $8.5 billion. All
right, Jen, great analysis. Jen Kniffen, who is the J. Rogers Kniffen Worldwide CEO, and of course our very own Brooke DePalma, tracking all things Macy's and retail. Thank you both. Well, Florida Governor Ron DeSantis has officially ended his presidential bid, paving the way for former President Donald Trump and former South Carolina Governor Nikki Haley to square off in tomorrow's New Hampshire primary. Haley has received extensive backing from Wall Street over the course of her campaign. We spoke with IBM Vice Chair Gary Cohn about Wall Street support, and here's what he had to say.
Wall Street, like most of the world, would like to hear a variety of opinions and how people would deal with the current situation that we're in. Because look, we're in a pretty tough environment in the world today, not just economically, but if you look at the geopolitical environment and you look at the political environment, we've got a lot of problems around the world.
Yahoo Finance's Rick Newman joins us to set the scene. Hey, Rick, which candidate would be better, at least by Wall Street standards?
I think Gary Cohn was trying to say diplomatically, we prefer somebody other than Trump. But I don't think that's going to be the case. So in terms of what markets might prefer, keep in mind that Donald Trump wants to impose a 10% tax on almost all imports to the United States. I mean, if Trump were to get elected and actually do that, which he could do without congressional legislation, I don't think markets would love that. But the question, of course, is whether Donald Trump would be able to beat Joe Biden in the general election. Nikki Haley, not into an imports tax, and she's more of an interventionist. She has had a lot to say about trying to help Ukraine and be involved. Trump, more of an isolationist. So when Gary Cohn talks about geopolitical risks, Trump basically says, let's pull back from all that and let the world handle its own troubles and get out of it.
And Rick, we also heard from Steve Schwartzman, Blackstone's CEO out of Davos. Julie Hyman and Brian Sazzi had the chance to speak with him, and they asked him about what he needs to see in order to endorse a candidate. I want to play a quick bite of what we heard from Steve.
I'd like to see, what the public has to say. with a number of shots on goal.
Do you want to see what the courts have to say as well? Is that going to be important?
I think that's a separate issue.
And Rick, he also went on to say that there are always uncertainties in all U.S. elections. This one may have more than others. My question to you, though, is as we look ahead to New Hampshire, if Haley does win, how much is that really going to alter the narrative of this race?
It would be a big surprise if Nikki Haley won in New Hampshire. I almost said South Carolina. Sorry, that comes next. And she's down by 11 or 12 points. And if she does win in New Hampshire, she could attract more funding and maybe, create the possibility that somebody other than Trump could win. Maybe Trump's legal problems would work against him. But this is a long shot for Nikki Haley. Let's be clear about this. So there's some tension and some drama in the race right now, but I'm not sure that is going to be the case after Tuesday.
Certainly polls showing that Trump has a wide lead over Haley in the New Hampshire primary. All right, Rick, thanks so much for breaking that down for us.
Hey, guys.
Well, coming up, we've got much more from Yahoo Finance's Morning Brief. We'll bring you the top trending tickers on Yahoo Finance. Boeing, Archer Daniels, Midland, and Solar Edge among the most searched tickers on our platform. More on that when we come back.
Time for some trending tickers that we're watching today, starting with BA, Boeing. Trouble escalating for the company after the FAA recommended airlines begin inspecting door plugs on a second model, Boeing 737-900ER planes. Now you're taking a look at Boeing shares here pre-market, down by about 0.6%. This is continued pressure and spillover from last week, but continued investigation around some of the airlines, or around some of the aircraft specifically. And so the FAA especially is just trying to get it ahead of it as best as possible at this point, but instructing the airlines that operate this particular aircraft to run this inspection.
Yeah, and Brad, it's also important to point out here that these checks are recommended. It's not required. So maybe why we're not seeing a bigger reaction in some of these airline stocks is just because they don't immediately need to take these aircrafts out of service in order to conduct these checks. So a bit of a muted reaction then when you take that into account for some of these airline stocks. Now, these checks, it does involve just short of 400 planes, about 380 planes that are between 5 and 17 years old. But again, the reason that we're talking about this is just the long line of issues that Boeing has had to deal with over the last several years. So just the fact that this probe has now expanded just a bit, and they are now encouraging airlines to check door plugs on a second Boeing jet, it could potentially signal more risk for this stock ahead.
Yeah, absolutely. And ahead of some of the airline earnings that are set to come forward too, it'll be interesting to say what CEOs have to say about either their orders or their confidence in Boeing as well, where we were able to get that comment from Delta CEO when they reported earnings 2 weeks ago at Bastion, saying that he still has full faith, but we'll see where other airline CEOs add on their own kind of tenor to that conversation.
Yeah, certainly, and we'll hear from some of those airlines later this week. All right, we are also watching shares of Archer Daniels Midland ADM sinking after slashing its earnings outlook amid a pending investigation into its accounting practices. Now, the company has also put its CFO on leave effective immediately. You're looking at the stock off just about 17% ahead of the open. If that decline does hold into the open, we would be looking at the largest intraday drop that we have seen for the stock since April of 2005. So putting that in perspective, right now wiping off more than $6 billion off its market value. So they're withdrawing their outlook for their nutrition unit. I'm focusing on that because this company has spent billions of dollars expanding their nutrition business over the last 10 years. And this segment operating income forecast, they forecasted to drop more than 18% in 2023. That would be the lowest, Brad, since 2020. So you stack all of that up, obviously a number of headwinds facing ADM stock, and you're seeing some of that concern reflected in the share price here this morning.
Yeah, we do know as well that Ismail Roig is going to be the interim CFO, Chief Financial Officer at the company as well, and had previously served as president of their EMEA division at the company, and oversight of all of the business was within that region. But as you think about going forward, what this is going to mean for some of the disclosures as well, pushing back some of the timing for their reporting, and then additionally saying that they're going to be providing an update on that 2023 outlook, announcing the expected delay of the earnings release and conference call related to fourth quarter and full year 2023 financial results, as they have to do some reconciliation here.
All right, let's get to today's stock to watch, and that is SolarEdge, the company announcing it will be laying off 16% of its workforce. That equates to about 900 jobs as it looks to cut back on operating expenses. So a leaner company, also a theme that we've been hearing from Wall Street over the last several weeks. Madison Mills has more for us on the floor of the New York Stock Exchange. Maddie.
SolarEdge laying off 16% of staff, like you mentioned, Shauna. But this morning we have news about just how much that staffing change is going to cost this firm, to the tune of $59 to $66 million, just in terms of the asset allocation to pay for those layoffs and offloading that amount of staff. Now, this comes after a really tough couple of years for this name. It's down about 80% from its initial valuations when it was listed. Also, a couple months ago, they got removed from the S&P 500 due to their low performance. And this is a story about the solar sector. This sector has been really struggling because it's an interest rate sensitive sector. And that's why we're seeing a lot of the names in this space struggling, including SolarEdge. They're blaming this on lack of demand coming out of Europe in particular due to excess inventory, weakening demand. We're also seeing that here in the States, again, because this is such an interest rate sensitive sector. But this is also a story about layoffs. This is a company that is just the latest in a growing list of firms that have laid off staff so far in 2024. We have it joining the names of Amazon, Alphabet, BlackRock, Citi. And it's interesting to see how the street reacts when we do see companies cutting back on staff. There's usually a little bit of a dip initially, and that's what we saw with SolarEdge yesterday. But today, we're seeing some rewarding from the street due to this cost cutting, because now the firm is going to be able to put that money back into itself and invest in itself. And that may be one reason why we're seeing this name up a little bit over 4% in today's pre-market trade.
Yeah, Madison, labor market limbo was our theme of Friday's show, and so it continues to permeate even as we kick off this trading week. Maddie Mills down there at the floor of the NYSE. We'll check back in just a little bit closer to the bell. Everyone, we've got all your markets action straight ahead. We're counting you down to the market open. You're watching Yahoo Finance.
And there's the opening bell on Wall Street. Lots of excitement as we kick off what could be another record-setting week here for the markets. You're looking at Archer there bringing the opening bell from the New York Stock Exchange, and also some excitement there from the Nasdaq. We got team coverage for you of the biggest market movers that you're seeing at the open. Yahoo Finance's Madison Mills still standing by for us at the floor of the New York Stock Exchange, and Jared Blickery is by the Interactive taking a look at some of those big moves here at the open. But Maddie, let me first send it down to you. What are you hearing from traders as we kick off a more optimistic, hopefully, a week here ahead of some of these very important earnings results that we're going to be getting out over the next several weeks?
Well, once I get traders to stop talking about the Chiefs-Bills games from last night and we start talking about what's going on in the market trade this morning, it was a big game, but we got a big week here in the markets, and that's what we're talking about this morning because we're seeing, of course, more green on the screen after record-breaking highs. But the question is, could we see the S&P break out of this 12th week of gains in the past 13, just that 1 week of negatives here from the S&P? And that's the big question. Having said that, we're seeing some hedge funds shorting the broader market here. We're seeing hedge funds shorts outpacing longs at a rate of 2-to-1 over the past week, a rate of 3-to-1 over the past year. So maybe seeing a little bit of profit taking that's going to be impacting the broader trade. And that's what can kind of stand to explain some of those random days when we see red, when we're seeing a broader gain across these markets here. I want to take a look at the Magnificent Seven. Tesla, the only laggard so far in the day, seeing green across all the major indices. But the question is, are we going to see a broadening? Max Kettner from HSBC throwing water on that idea this morning, saying that there's no more room to go up without that broadening. Stuart Kaiser this morning saying that if we don't see that broadening, we are probably not looking at investing more into things like the Russell 2000, which is down about 3% year to date. Instead, looking at something like maybe the S&P equal weighted index. But again, that is far more performing in the laggards than the green, which is what we're seeing in the broader S&P today.
All right, tons to keep track of. Just beginning a new week here. Fresh breath of air for everyone here, Madison. Thanks so much for teeing it up. Jared Blickery is also standing by. He's here at the home base with the Yahoo Finance Interactive. Jared, what are you watching?
It's a tale of two markets here. In the West, we have a lot of green on the screen, and that's what we've been seeing recently. S&P 500 at record highs, and yet over here in Asia, especially in China, we have some deep red going on. First, let's take a look at the Shanghai Composite year to date. This is what's going on over the last 24 hours. Here's year to date, down 7.35% over the last year, down about 15%, but it gets worse. Usually in China, the Shanghai is a little bit more volatile than Hong Kong, but Hong Kong is doing worse. Over the last year, more than double the return of China, and that's to the downside, down 32%. And just by the way, let's compare that to Tokyo, where we have the Nikkei at a 34-year high, not quite record, but at a 34-year high, up 37% over the last year. And a picture is worth 1,000 words, so let's just take a look at some of the heat maps here. This is a sea of red, but this is only what's going on today. Here is year to date in the Nasdaq Golden Dragon China Index components, and a lot of the components here listed in Hong Kong, like Alibaba, that's down 13% this year alone. Over the last year, you're not going to see a lot of green here. Pinduoduo pretty much carrying the water for the entire sector, for the entire country. That's up 52.7%, but that is the outlier. Take a look at the equal weighted version of this. Everything from here down in dark red is down 40% or more. That is just an incredible amount. Now, China has taken so many lumps that I would say maybe it's time for a little bit of a rebound here. I couldn't say that for sure, but you take a look at some of the U.S. listed stocks that have a lot of China exposure, like Nike. Those are down this year. Those are suffering. Starbucks has been kind of floundering over the last year. China has just been a sore spot. Another final point to consider is that emerging markets, ex-China, have actually done decently well. It's really China being the outlier here, guys.
All right, Jared, thanks so much. Continuing to track the overseas movements as well here internationally. The S&P 500 is pushing higher today after hitting all-time highs last week, even as chances of a March Fed rate, Fed rate cut, I should say, they drop to less than 50%, according to the CME Fed Watch tool. So as the debate on when the Fed will cut rates rages on, where can you invest to hedge your bets? To tell us more, we've got here, live in living color in studio, Octavio Morenzi, Optimus CEO. great to see you in person after. So it's been a while.
It's been a while, indeed.
Indeed. So
It's
all right.
good to see that you're real people.
I mean, you chose the best time, right? We've got all-time highs for the S&P 500. I mean, if you're an investor looking at this market environment right now and have to also kind of pair this with the rate cut probability as of right now, what should be going through your mind? What should be kind of top of the docket for any of your portfolio strategy?
Well, I think all eyes are really on the Fed right now, what they're going to do at not this next rate meeting at the FOMC, but the one that follows on in March. What are they going to do there? And I think the consensus for some time has been now they're going to cut 25 basis points or 50 basis points, and now that's starting to look less and less likely. So that's starting to sort of melt like a snow in the sunshine and basically say, where are we going to go now? What is the Fed going to do? Now, I think if you look at the Fed, and the data that they look at and the markets and where the economy stands and where unemployment stands, you put all those things together, I don't think there's a very strong case for the Fed actually cutting rates at all in March. I think quite the opposite. They're just going to look at it and say, inflation's coming down slowly. It's more stubborn than we'd like. The last core inflation reading was 3.9%. Unemployment is low. The economy is doing well. Markets are record highs. Why would we cut rates now? Does the market really need another boost from the Fed? It doesn't look like it does. So I think this will embolden the Fed to do nothing. And just wait. And I think we'll see the chances that there's nothing happening go up above 50% as we get closer to the date.
Octavio, how much of that first rate cut, how much does that really matter to the markets here in terms of, has some of that hype been a bit overblown? And then when you put this in perspective in terms of the pace of cuts, should we be putting a little bit more weight into that rather than the timing of that first rate cut?
I think that's absolutely the right question, is how much are they going to cut over what period? And the Fed tends to, once it starts moving in one direction or the other, either increasing rates or decreasing rates, carry on moving in that direction for an extended period of time. So they tend to move for 12 months, 18 months in the same direction as they adjust their interest rate policy. So you're absolutely right to point out when exactly that starts is not so important, perhaps. But if inflation stays high and if the economy carries on doing really well and employment remains low, I think they'll postpone that further and further out, and we might end up waiting a long time indeed. Now, I don't know when that's going to happen. I wish sometimes that the Fed would share their econometric models with us, since they're a public institution. They could share all their data and their models with us, and they could all figure out for ourselves when they're going to cut rates or increase them.
And then we could be our own dot on the dot plot. Why not?
We could indeed. We could indeed.
And so, I mean, all that considered, there's also the international conflict that a lot of people are trying to figure out. How does that factor into our economy here in the U.S., and will that weigh into the Fed's decision at all?
I don't think that will weigh into the Fed's decision, sort of the geopolitical context right now. I think the U.S. economy is mercifully sort of isolated from that, except from the oil side, so that could be a big impact there. But I think in that kind of sort of geopolitical uncertainty, we've tended to sort of overweight gold a bit and say that looks like a good investment, a good place to be. We did see gold have a nice run up over the course of the past few months since late October as a result of these hopes of interest rate cuts as well, I think, more than anything else. But I think given the geopolitical context, it looks like a good investment again, potentially over the course of the next few months.
Octavio, the results that we've gotten from the S&P 500 companies so far has been a bit disappointing. A lot of that driven by misses that we saw, or downside surprises, I should say, from some of the bank stocks. As you look ahead to the results that we're going to be getting over the coming weeks, are you expecting a bit of a change in terms of that narrative, and what specifically are you looking for?
Well, if we look back at the bank stocks, we had an unusually wide dispersion of the results. Usually all the banks sort of move together and they get very similar results overall. This time around, we saw JP Morgan do fantastically well, Bank of America do okay, Wells Fargo sort of middling, and Citigroup do terribly. And so there was this big spread of results that we usually don't see. What we did see there was net interest margins come down a bit, some tightening. But on the positive side, and I think it's not so much about the bank stocks themselves, but looking at the bank's financials, it tells you a lot about the economy in general. So we saw spending levels were still pretty strong, and credit card expenditures still very, very strong, people spending lots of money, loan balances very resilient and robust. And also, I think most importantly, default rates on loans remained very, very low. And that was a very important point as well. And that suggests that both the corporate consumer and the retail consumer is doing very, very well indeed and is not at risk of defaulting. So I think that bodes well for earnings coming out and well for the economy overall.
All right, Octavio Maranzi, always great to have you. And thanks so much for joining us here in studio. Always great to get your insight.
Thank you.
All right, well, let's stick with the earnings conversation because new data out from FactSet showing that fourth quarter earnings results are off to a sluggish start with about 10% of S&P 500 companies reporting results so far. Earnings have declined about 1.7%. Here with more, Yahoo Finance's markets reporter, Josh Schaefer. And Josh, we were just talking to Octavio about this, but looking ahead in terms of what the street consensus is coming off of these results that we've gotten so far. What do you make in terms of that setup then heading into these results that we'll be getting over the coming days?
Yeah, I was thinking as you guys were just talking, like if we want to call it a hockey shootout or something, you normally want your top scorer to go first. And we kind of just sent out, and we just sent out, maybe like a third liner or something when we're thinking about financials and thinking about this.
Not great.
Not good if you're not a hockey fan for that comparison.
It's me.
But we have tech coming up, right? And tech is one of the sectors that people still expect to do well. And when I'm talking about tech, I'm not necessarily even talking about Netflix and Tesla, which you see on the board there. Remember, they're not actually core tech companies. We just refer to them in that sense. But we really have tech earnings in and of themselves next week. But one thing that's been interesting to see so far, and I'm curious to see if this narrative changes, is Bank of America was out with one of their earnings updates pointing out what the stock reactions have been. So companies that beat on revenue and beat on earnings, beat the street's estimates on both, their stock the next day up 0.2%, 20 basis points. Not very impressive if you're someone that owns one of those stocks and is happy your company beat earnings, right? But if your company misses on both, down 5% the next day. So we're seeing when you have the S&P 500 at a record high, it takes a little bit more to get your stock to actually go up. And I think that's one of the more interesting things right now, along with margins. Margins is something that I think we're going to hear a lot about this week when we talk about Tesla and talk about Netflix.
Does it seem like there's just one big theme that we could hear time and time again, kind of just resurfacing among some of these earnings calls?
Yeah, I mean, there's a couple, Brad, right? Because we're talking a lot about the labor market, right, I think, right now, and talking a lot about what companies are doing in terms of either resizing or not resizing. And I think it's going to be interesting as we get through tech earnings in the next 2 weeks, where it seems like a lot of these layoffs are coming from, to actually hear what management says about them. I think is going to be interesting. And then we did just have that graph up on margins, and I did want to highlight this one. Margins coming in at their net profits margins coming in at their worst percentage in about 3 years right now. Now, of course, some of the highest margin companies, again, we're looking at tech and communication services. Think about how Meta's turned around their margin story in the last year and led this market higher. They haven't reported yet, so that doesn't include them. But I'm watching that number because there is one company that reports this week that's had a pretty bad margin story for several quarters now, and everyone likes to talk about it, and that's Tesla. So I'd be curious when you think about Tesla. Also, even Netflix has been a margin story that people talk about a lot, but specifically Tesla, because the margin story hasn't gone great. Be interesting to see what we hear and how that narrative sort of shifts this week.
Yeah, exactly. We're going to be talking to an analyst from Canaccord next hour, and that's exactly right. He was saying one of the biggest themes to watch for in Tesla, and also what it's going to really tell us going forward is just more so with the EV space, but that margin story, right, in terms of demand, the pressure that we could see, and some of the pressure that then maybe that we're expecting could then be present with Ford, GM, then with the other
The market bears have been waiting for inflation to weigh on margins significantly for like 3 years now. So if we get it,
may finally be right.
Yeah, that'd be a big victory.
Yeah, they're sticking with
Long
it.
time
They're sticking
coming.
with it. Yeah, you got to give them the respect for that. All right, Josh, thanks so much. We'll keep right here on Yahoo Finance's Morning Brief. We got much more of your market action ahead. We'll be right back. Well, slowing EV demand could be a big theme for earnings results this quarter. Now, Ford, the latest automaker to pull back on its EV initiative, announcing on Friday that it's reducing production of its F-150 Lightning pickup truck. Ford CEO Jim Farley spoke to Yahoo Finance last week about electric EV adoption, and here's what he had to say.
We're seeing mainstream customers who are interested in EVs, but they're not convinced, and they're not going to pay a big premium. So what it means for the OEM is cost. We have to dramatically reduce the cost.
Well, Farley also went on to say that Tesla's price cuts have put pressure on costs across the sector, and all eyes are going to be on Tesla's results this week. They're out after the bell on Wednesday. It's going to give us a better sense of what EV demand looks like, also the pressure that we could see on margins and whether or not that is going to play out with the rest of the sector. So for that, we want to bring in our next guest here, and George Giannarchis is... I probably butchered your last name. I'm sorry there, George, but you're joining us here with Canaccord Genuity. Thanks so much for joining us. So, George, let's talk a little bit about what we could likely hear from Tesla. Lots of focus on EV demand, the fact that that is slowing. Are some of those fears a bit overblown?
It could be. So first, thanks for having me on. Look, last year, Tesla, as you alluded to in your previous segment, had an issue with margins. And that's because they cut prices several times throughout the year, actually starting in late 22, to combat what we think was just an impact on demand from an increase in interest rates. So they cut prices basically to keep that monthly payment the same, because most people who buy cars have a monthly payment, don't pay cash up front. So what we saw for Tesla was an impact to margins, gross margins, which they promised were probably going to have a line in the sand in the first quarter of 23, kept going down throughout the year. So when we look at what the company will talk about for 2024, it's a really, really important call, because for us, it means two things. First, what's Tesla's path to earnings in 24, 25, and 26? And next year, or this year, I should say, we'll probably see a slight increase in earnings, depending on what they say about margins and units. And the second thing is to combat this narrative that's been really accelerating over the last several months, that EV demand is terrible. People don't want EVs anymore. We think it's a symptom of a few things, most likely that don't have anything to do necessarily with the EVs. EVs just happen to be higher in price. And so when interest rates go up and they impact the price of that monthly payment, you're probably going to see an impact to the higher priced vehicles, which in general are EVs. And by the way, a lot of the EV offerings in the market today stink. They're not as good as Tesla's or Rivian's, for example. They don't hold water to what those two companies are bringing to the market.
And so, George, that has been one narrative that has emerged over the last couple months, as you mentioned, EV demand being terrible. One other narrative that's emerged is that Tesla is an AI company. Give us your perspective on that.
I completely agree with it. But the problem right now for Tesla is that, well, why are they an AI company? The big reason for that is the full self-driving software, the FSD software that they bring into the marketplace. And so right now, that costs about $12,000 if you're in the United States. And in our opinion, that's too expensive. So the real earnings growth story for Tesla is it's twofold. Number one, you get those units really going. And right now, we have this slowdown in unit growth because of the macroeconomic issues that we talked about. And we may have reached some sort of ceiling on what the Model 3 and the Model Y can sell. But then we also need margin expansion relative to the margin compression that we've seen over the last several quarters. And the big way to get to that margin expansion is start selling more FSD software. And that FSD software, that full self-driving offering that they have, is based on artificial intelligence and machine learning. There are two competing ways to bring self-driving to the marketplace. Tesla has end-to-end neural networks, camera input in, neural networks figuring out how to navigate your vehicle, and navigation out. Other companies like Mobileye and Aurora are bringing some sort of hybrid approach where they're using AI and they're using traditional software. So Tesla is an AI company. That's the story. Unit growth plus that big margin boost from selling FSD software, which is based on AI.
When does that, from your perspective, start to get fully valued into Tesla and the stock price?
Well, that's the million, the billion, maybe even the $1 trillion question. You know, it really has to start impacting margins so people can draw a straight line to $10, $15, $20 in earnings. I mean, right now, those automotive gross margins are in the teens. But if you just think about this logically, if you're selling, let's just say the average price of a Tesla vehicle is anywhere between $40,000 to $50,000 today. Well, if you can add, and they're selling it for teens gross margin, if you could add $12,000 of ASP, of average selling price, that's at a 90% plus gross margin, that has a huge positive impact to your gross margins. So we really have to see an acceleration and adoption of full self-driving software, and then we can really see a big margin boost. And if we do, that earnings power really starts to ramp, and people will get excited about the stock again.
Well, George Gianarikas, we really appreciate your insight here ahead of these results. Look forward to your reaction after the results that we get later on Wednesday. George, thanks so much for your time.
Thank you.
All right, we've got much more of your market action ahead. We will be taking a look at the beleaguered home builder sector, with firms coming out with worries about consumer trends in that area and what exactly that means for investors, for shareholders. More on that when we come back.
Welcome back, everyone. We're taking a look at home builders this morning after a series of downgrades from firms on several stocks. Oppenheimer downgrading both Home Depot and Lowe's to perform from outperform and slashing price targets on both stocks, while Seaport Global is cutting its rating on D.R. Horton to neutral from buy. The firms are citing worries about consumer trends for the rest of the year as persistently high inflation continues to hit people's wallets. There are a few things to break down here within this. First, let's start with Home Depot and Lowe's, as you've got that pulled up on your screen here, and diving into what Oppenheimer has been saying about specifically Home Depot and Lowe's and this unfavorable guidance that they're giving. They essentially think that there's complacent positioning within the market, and then that's going to hit on both of these names here, notably fretting some of these shorter-term market positioning towards Home Depot and Lowe, turning too complacent. Shares might not discount adequately for potential persistent fundamental weakness at the chains here in earlier fiscal year 2024 is what they said.
Yeah, I think a lot of this just points back to some of the common themes or ongoing themes, I should say, that we've been talking about in the market, right? We certainly have seen a slowdown in housing activity, and also we're in an environment of elevated rates. Two scenarios and two trends that would point to softness likely here for names like Home Depot and names like Lowe's. And we certainly are seeing that case being made here from Oppenheimer. And Nagel went on to say that he does not envision a market re-strengthening in demand trends within the space until later 2024 at the earliest. So this is a rebound or a recovery that he is basically saying that he wouldn't be shocked if we don't see until 2025. Again, a lot of that because of the elevated rate environment that we are currently in. And going back, even tying in to comments that we just heard from Octavio, talking about the fact that, hey, it wouldn't be unheard of for the Fed to continue to delay that first rate cut. Certainly the market is not as optimistic as it was that we were going to get that March rate cut. If we don't get it in March, it's not necessarily that we're going to get it in the first half of the year, and maybe not even at that first meeting in the second half of the year when you look ahead to July. So the fact that we could see a further delay in rate cuts here could put pressure on names like Home Depot and Lowe's, especially given this investment thesis here from Brian Nagel.
Yeah, it's amazingly critical to continue to track the backlog for a lot of these home builders that are out there, what that means for their relationship for large purchases that could come into Lowe's, come into Home Depot, as Lawrence Yun, who is the chief economist over at the National Association of Realtors, reminded us last year that we are still trying to add in more supply to the markets to actually make sure that there are enough homes that are out there to quell some of the demand that we've seen. And we spoke with him on the back of some of the existing home sales figures that came out showing that mortgage rates meaningfully lower compared to just 2 months ago. More inventory expected to appear on the market in upcoming months here as well in the existing home side. And we'll see on that new home side and how that affects some of the home adjacent stocks here.
Yeah, certainly important for investors to keep in mind as they're planning out their portfolio. All right, we'll keep it right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
Happy top of the 10 a.m. hour. Welcome back to Yahoo Finance Live. I'm Brad Smith alongside Shauna Smith. We are about 30 minutes into the trading day on this Monday. Let's take a look at how things are shaping up right now. Stocks are higher as the AI euphoria pushes tech stocks higher this morning. You're taking a look at the Dow, the S&P 500, and the Nasdaq. Fractional gains across the board right now.
All right, let's take a look at some of those individual trending tickers on Yahoo Finance, starting with Alibaba sinking along with the rest of the Chinese market. Now some jitters around China's slowing economic growth remaining here as the world's second largest economy kept its loan prime rates unchanged. You're looking at losses here for Alibaba off just about 2.5%.
And cyber stocks also on the move. CrowdStrike, Zscaler, Okta, and Palo Alto Networks all jumping. These stocks buoyed by the ongoing tech rally as investors remain optimistic about the artificial intelligence-driven demand.
And Xpeng falling on a report that it is undertaking a round of organizational restructuring led by its new president, who is approaching her first year on the job. Now, the changes will impact many sectors of the company, including its manufacturing and product planning. And this comes amid growing competition in the Chinese EV market. You're still, though, looking at some pressure on the stock. It's off just about 1.5%.
We're also tracking Sony shares popping today after announcing that it is calling off the merger with its Indian unit with Mumbai-based media company Z Entertainment. After about 2 years of negotiations, the deal, valued at $10 billion, failed to close by the January 21st end date. Now, Sony is seeking a termination fee of $90 million from Z for alleged breaches of the merger agreement terms here. So that's something that is no doubt heading to the courts and determining whether or not that full fee will be paid out here as well.
Yeah, and the reason why Sony was initially interested in Z was because of the deep library that the company does have when it comes to some of those regional Indian languages and dozens of their local TV channels. So they're trying to push further into this region. That, of course, will be critical here going forward, given their deep content, the library content that they have. Now, the reason why we're seeing the stock price move higher today, obviously, is tied to the financial transaction part of the deal and the fact that they won't be spending that much money on this deal could at least move the stock higher, at least in the short term. But down the line, you got to think about how this potential termination here is going to impact Sony's approach to the Indian market. We know it's very important in terms of the growth trajectory there and how that is also how they're going to navigate some of these headwinds here in terms of getting a deal like this approved and also shareholders on board going forward.
It was really interesting because even as this was playing out, one of the larger things was you had in that region, in India as well, Disney selling off, or at least in talks in fourth quarter of last year, selling off its India business to Reliance. So now there's a question of, okay, if all of these things are still perhaps in limbo or in conversation, does Sony look at another entity within that region that gives it the type of reach that it's looking to get among that entertainment consumption profile and consumers there as well?
Yeah, certainly. And it's going to be a name here to keep in mind as we look ahead to some of those trenders that we are likely going to see here over the next coming weeks. All right, well, we want to get to one of the big themes here at Yahoo Finance, and that is AI. It certainly has been driving the market's momentum as of lately, and you have to look no further than NVIDIA. This stock has certainly been a standout so far this year, and especially looking at that one-year chart where shares up just about 250%. So could a company potentially derail some of the rally, some of the momentum that we're seeing in NVIDIA? And for that, we want to bring in Dan Halley, our tech editor, who has closely been tracking what has turned out to be a phenomenal story right now for the markets, Dan.
Yeah, NVIDIA basically is just, the AI king, right? And they have been for quite some time. I think, this is something that years ago when they first started investing in AI, the idea was they just went to universities and said, what can you guys do with these powerful graphics processors that we have? And AI happened to be one of the things that came up. And so, they began investing. Companies thought that they were crazy, and their own backers thought that they were crazy. They were like, why are you dumping so much money into this? It's paying off huge, right? They eclipsed the $1 trillion mark as far as market cap goes in June, and they were closing on a $1.5 trillion as of Friday. But there are some rivals out there, and I just want to go over a few of them here. The big ones really are AMD, which has been kind of a long-time thorn in their side, and Intel. Surprisingly, Intel, and I say surprisingly only because they haven't done as well in the graphics card space at all. And so when you look at what Intel and AMD are doing, right now NVIDIA's best chip is the H100. AMD has the MI300, which they announced in December. Intel is working on their Gaudi AI accelerator. Those are going to be potential options that companies can use in place of NVIDIA's offerings. Now, it's important to note that NVIDIA, they are the leader when it comes to hardware. They're miles ahead of everyone else. It's going to take years for other companies to catch up. But on the software side, they're also huge. That's a big moat for them, where they have this CUDA software where companies can go out and build their own kind of AI platforms around this. And so that helps keep people wrapped into the NVIDIA system. So it's a big deal here. Hyperscalers also have their own chips that they're making that could also prove troublesome for NVIDIA.
Right, and Dan, I mean, we talk about AI all the time as this broad concept that is going to certainly revolutionize, change tech forever. Can you tell us, though, exactly how consumers can use AI right now? Where is it present in my fingertips, even?
So right now, it's funny, if you ask Intel, right, they announced this event, they had this AI Everywhere event. Yeah. And they have new chips where they have NPU, neural processing units. Those have been in the iPhone for a long time, right? Neural processing engine. So now they're in Intel chips, they're in AMD chips, they're in Qualcomm chips. So they're coming to laptops, desktops. They're coming to smartphones now. The new Samsung phone, the Galaxy S24, as well as Google's Pixel has them. You can expect Apple probably to get on the train more with generative AI. If you ask Intel what that means, though, they literally say, we don't know right now. We don't know yet. Developers have to come out with apps that take advantage of this. But there are some ways that you can take advantage of it. When you use your laptop or desktop, you can run generative AI apps on there. So if you want to do some generative AI with images or with text, the idea is that you would be able then to do it all locally. That means more security, more privacy, since you're not sending your data up to the cloud, it's all on device. That's with the laptop and desktop. Microsoft is doing that. On the phone with Samsung or Google, there's image generative AI where you can change around some photos. I can make myself look like I can slam dunk. I cannot. I can't.
You told me you could.
Well, yeah, that was a lie. So there goes all my integrity. But I can jump like an inch, maybe. But I can make it look like I'm a monster.
Jump an inch.
Now, they got weak ankles. Weak ankles.
Well, thanks to generative AI, you can jump much higher, Dan.
I can live my dream.
Yes. Well, it's our dream to continue this conversation here, and we will all week long for Artificial Intelligence Week. Dan Howley, thanks so much. Well, generative AI hopium has fueled a rally in the tech sector. The iShares Semiconductor ETF is up 60% over the last year. But our next guest cautions that an absence of tangible results following AI investment may puncture the current demand for AI chips. Joining us now as part of our AI Revolution theme this week is Richard Windsor, Radio Free Mobile founder. Richard, you got to take us into this expectation yet. Okay, we're going to get Richard back here. We're going to go to a quick break. And actually, let's take a look at one particular roundup of artificial intelligence commentary we've gotten.
There's no doubt NVIDIA was 2023's AI champion, but competition is heating up fast. Intel had a tough year, but now it's got new chips and a fresh AI software vehicle to boot. AMD is no slouch either. It sees a mega increase in the market for AI chips to the tune of $400 billion, and it wants some of that pie. We haven't even mentioned Microsoft. It plans to cover all the bases from silicon to service to meet AI demand. So who wins? Who gets left behind? What does it all mean for the future of humanity?
All right, everyone. Well, we teased a moment ago. Our guest here is cautioning against some of the AI hopium here right now. So coming in, we've got Richard Windsor, who is the Radio Free Mobile here. Richard, great to finally get you back on here with us. We tried a moment ago. One huge thing that we got to dive into right out the gate here. Why do you believe that some of the investment is going to perhaps see a bubble burst here this year? That's something that you mentioned to us in your notes.
Yeah, the problem you have with artificial intelligence is that the general perception seems to be that the machines have now become much closer to what's referred to as super intelligent. Part of the reason for that is when people talk to these machines, they get the feeling they're talking to an actual person. The reality is that we're no closer to super intelligence, I would believe, than we were 10 years ago. And now, while the generative AI is a big step forward in terms of what you can do with data and what you can do with sort of voice-based services, it isn't what everyone is promising. And what I'm worried about is that, combined with the fact that you're going to get massive competition with all these different services, it's also going to cause a lot of price competition, which means that revenue targets are going to be missed. So what we're saying is, to wrap it up, what we're really saying is there is a big use case for artificial intelligence. Yes, it's just not worth the valuations that people are ascribing to them because they think the prices are going to be much higher than they really are.
So then, given that, Richard, if we do see this bubble that could potentially burst, it sounds like, at least in terms of the price valuations for these stocks, what does that mean then for a name like NVIDIA, a name like AMD that has really ridden this hype here to the upside?
Well, for NVIDIA, obviously, it would mean a significant correction, because what would be likely to happen if you got a correction in valuation, what that would mean is that people would probably start buying less training chips because they would cut their estimates in terms of the revenue or the return that they can have on that investment. So that would mean a significant correction for NVIDIA. It would also mean a correction for AMD. If you look at AMD's valuation compared to the rest of the semiconductor sector, arguably it's very rich. So I think what you would see is a big correction. Now, the good news for NVIDIA is there are lots of people trying to challenge it in terms of being the AI training place to go, and no one has really laid a glove on the company yet.
NVIDIA was the runaway story of 2023. 2024 now, what is the best company that is positioned to perhaps siphon or at least poach some of that demand away?
This is the problem. It's going to take a long time, because what really has happened is that through 20 years of investment in CUDA, CUDA is the place where everybody wants to go to train their AI algorithms. And so consequently, they demand NVIDIA. This is why you had Google invite Jensen on stage at I/O. This is why you had Satya Nadella invite Jensen on stage at his event, because his customers are saying, if you don't give me NVIDIA's chips, I'm out of here. And that's why these guys are all trying to develop their own chips. The problem is, until they get the software platform right and they can start to grab developers from NVIDIA, nothing's going to happen.
All right, when we talk about some of the future, opportunities here, then looking forward, the use cases, what investors need to keep in mind, they're trying to figure out the best time to buy in. Should they buy in? What are the top one or two things that you think investors need to keep in mind then, in terms of some of what you're saying could be maybe a bit of a disappointment there in terms of valuations, this run up here over the next 12 months?
Yeah, that's part of the issue. Now, I think the first thing to look for is that there are a number of companies out there that have significant exposure to AI, but it's not really been priced in. And I would immediately highlight Google, Meta Platforms, and even, if you're feeling exceptionally brave, Baidu out of China. Now, the problem with these as AI or generative AI investments today is this is not where their revenues come from today. And so consequently, you are also making an investment in whatever their current business. So in Google's case, it's search. Baidu's case, it's Chinese search. And Meta Platforms, it's social media. So you have to be prepared for that. And again, it is going to be a long-term investment. This is part of the problem. If you want to get in on the generative AI craze, NVIDIA at the moment is really the only pure play that's out there, apart from a few other small cap peripheral-like companies.
And NVIDIA on the chip side, but there's kind of different pillars to this, right? There's the chips, there's the models and the language learning models that sit on top of the chip, and then there's the applications. So of those other two pillars, are there companies that would be runaway market share leaders?
Well, yes, obviously, if you look at where the market share is today, it's OpenAI. The other problem, of course, you've got is the other pure players. They're pretty much all private at the moment, and there's no sign of them going public imminently. And so from that perspective, again, from an investment standpoint, it becomes very, very difficult. Now, the other thing to watch for this year in terms of the AI theme, last year was all about training, which is, I'm going to create my model to provide wonderful service X or wonderful service Y. This year is the year, I think, when these models need to start generating traction, traffic, revenue, and that's really what people are going to be looking. That's what I'm looking for in terms of supporting this trend. But again, I'm a little bit concerned that price erosion for these services may cause revenues to come in softer than expected.
Certainly what shareholders seem to be wanting to see as well. Richard Windsor, always great to get your insight. Radio Free Mobile. Thanks so much for joining us here this morning. All right, keep right here on Yahoo Finance. Much more of your market action ahead. We'll be right back.
The price of Bitcoin has no shortage of catalysts, from the debate around regulation to whether it's a security or a commodity, and whether or not it really is digital gold. But one event is undeniable in its impact on the world's most premier digital asset, the halving. Every 4 years, the reward for mining the biggest cryptocurrency is cut in half. This happens in order to reduce the amount of coins in circulation. How is it calculated? Well, it happens specifically every time 210,000 blocks are mined. We can calculate the date fairly precisely with the knowledge that the average block time for Bitcoin mining is around 10 minutes. That calculation gets us very close to 4 years. Why is it needed? Because there's only so much Bitcoin available, 21 million to be exact. And like any other cryptocurrency, it needs to remain scarce to hold its value. So how often does this happen? Well, the halving takes place every 4 years. The first in 2012 decreased the award for creating a new block from 50 to 25 Bitcoin. The second halving in 2016, that lowered the reward further from 25 Bitcoin to 12.5 Bitcoin. Last time out, 2020. And you guessed it, we halved again. The block award dropping to 6.25 Bitcoin. So there's nothing wrong with your math here. This time around, the block reward miners will receive half, 3.125 Bitcoin. The big question, of course, what happens to the price? Now, the moves could be significant. In the past, we've seen Bitcoin rise after a halving event, though there's no certainty that this will always be the outcome. The other key focus is the outcome for the miners. The rewards that they're generating will, of course, diminish, and that's not great for an industry with a very high cost burden. Keep an eye on how the big publicly listed miners, the likes of Marathon and Riot, manage this event. As ever, talks of consolidation will no doubt do the rounds. No matter how you look at it, the event will have serious consequences for all crypto stakeholders, and will be across all of the developments here at Yahoo Finance. Sunoco is acquiring pipeline operator NuStar Energy today. All-stock deal valued at over $7 billion. And to break this down for us, we've got Yahoo Finance reporter on the case, Inez Ferre. Inez, what do we know?
Yeah, Brad. So you've probably seen Sunoco gas stations. This is a fuel distributor. Meanwhile, NuStar Energy, that's a liquid terminal and pipeline distributor or operator. So what this means is basically that Sunoco, they take other companies' fuel and distribute them to gas stations, for example. And what this merger with NuStar will do is it'll tie into its sort of distribution network, because Sunoco depends on other companies to be able to deliver fuel. Other companies like NuStar, it makes sense to kind of vertically integrate NuStar. And according to their press release, this is going to deliver some significant savings right away. Citi analysts saying that investors expected Sunoco to acquire something because of their equity and cash infusion and the M&A environment. So this is positive for the stock, even though today you are seeing Sunoco shares lower, of course, because it is the acquirer, and NuStar Energy shares that are higher.
Inez, let's stay in the oil and gas space for a hot second here. ExxonMobil suing two sustainable investment firms, companies trying to prevent a climate proposal by activist investors at the company's shareholder meeting in May. Can you tell us a little bit more about this one?
Yeah, and this is a significant move that ExxonMobil has taken against Arjuna Capital. That's an investment firm that's based in Massachusetts, and also Follow This as an activist investor that's based out of Amsterdam. And this is the first for the oil major, and it has to do with some proposals that these investment firms want. They have to do with Scope 3 emissions, not to get too in the weeds, but they are certain types of targets. ExxonMobil has announced a plan to reach net zero by 2050 for Scope 1 and Scope 2, not Scope 3. But basically what this complaint is saying is it's highlighting sort of what they're calling sort of a broken system when it comes to these shareholders that issue these proposals. It also highlights the role of the SEC, because it's been overseeing environmental and social shareholder proposals. And what they're basically saying is that these activists they acquire minimal shares, and then they put forth these proposals. These proposals, ExxonMobil is saying that they have already been put forth in the last two meetings, so back in 2022 and also in 2023, and they were rejected then. I just want to show you just a full screen of a part of the complaint and what it says. It says Arjuna and Follow This are aided in their efforts by a flawed shareholder proposal and proxy voting process that does not serve investors' interests and has become ripe for abuse by activists with minimal shares and no interest in growing long-term shareholder value. Guys.
All right, Inez, the story that we're going to continue to track. Inez Ferre, thanks so much.
Thank you.
Well, Trump-backed Digital World acquisition is surging today as Florida Governor Ron DeSantis drops out of the presidential race and endorses Trump. Look, you're looking at gains of just about 23%. Now, this coming ahead of the New Hampshire primaries tomorrow. And according to the latest polling, Trump's still leading by a wide margin with 50% support among Republican voters. That's compared to Nikki Haley's 39%. So here with more, we want to bring in Greg Valliere. He's AGF Investments Chief U.S. Policy Strategist. Greg, it's great to have you. So let's start with DeSantis exiting here from the GOP field. Is this going to, do you think, shift any votes in Haley's direction, or is this really largely viewed as a big win for Trump?
It's a win for Trump, and I think the race will effectively be over on March 5th, Super Tuesday. In fact, it's probably going to be over even before then. If Haley loses conclusively last night, does she really want to stay in and go to South Carolina and lose again in her home state? She may drop out in the next couple of weeks.
And so what does this mean for now an emboldened Trump?
Yeah, good point. I mean, I think Trump now will post. He's going to be raising money. He'll be making some speeches. And frankly, I think there's going to be a focus on his rhetoric. A few days ago, he got confused. He confused Nancy Pelosi with his opponent, Nikki Haley. And I think that people are wondering what happened. So I think there'll be a lot of scrutiny on Trump in the next few weeks. But make no mistake, he's going to be the nominee.
And what do you think the reaction is going to be from some of the biggest Wall Street donors? Because we know a number of them have been backing Nikki Haley here in the primaries. Where do you think then that support lies, and what does that then tell us about the setup here for the general election?
Yeah, I think that there was supposedly a big fundraising dinner coming in the next couple of weeks. A lot of Wall Street people were going to be involved in it. And I think now they'd have to worry that they'd be throwing their money away. I just can't see her winning. It'll be crucial to see how she endorses Trump once she drops out. If it's lukewarm, well, that's one thing. If it's enthusiastic, that's another. My hunch is it's going to be pretty lukewarm.
Greg, you mentioned the theme of mental acuity, and I'm not a doctor, and I am not set to evaluate either Biden or Trump, but if there was a independent party candidate that came about that seemed like they could perhaps be able to drum up enough of a base, how do you think Wall Street, how do you think investors, and more broadly, that person might be received?
It's a good question. And I sense as I travel around the country, people are astonished when I tell them it's going to be Trump against Biden. There's not much doubt about that. I think it's just sinking in to a lot of Americans. Therefore, I think a lot of Americans will look at a third party candidate. You know, Robert F. Kennedy has a magical name. He's pretty out there in a lot of things like vaccines. But I think Robert F. Kennedy in many big states in the general election in November could get 2, 3, 4 points. And that could be enough to turn the state around.
And Greg, there's also been the narrative out there, and many of this backed by Trump supporters, saying that Nikki Haley, if she does continue with her campaign and she does end up losing to Trump here in the primaries, that it could be problematic for her future in terms of running for office again. What do you think about that?
I think she has to calculate that. Well, she and all of the candidates have been calculating for weeks, if not months. Look at Tim Scott. I mean, his endorsement of Trump was very calculating. I think they're all thinking about a cabinet position. They're all probably thinking about the vice presidency. So I think they're going to tread very lightly on Trump, worried that if they don't, their political careers could be damaged.
Greg Valliere, who is the AGF Investments Chief U.S. Policy Strategist. Thanks so much, Greg. Always a pleasure to get some of your insights.
You bet.
The price of Bitcoin is sliding today as ETF fever seems to be cooling down. Investors are cashing out of their gains after spot Bitcoin ETFs were approved earlier this month, coinciding with the digital currency topping the $45,000 mark. With Bitcoin down and IXIC traders are bracing for a correction. All right, so a few things to kind of like step back and take away from this. Now, it's been a monumental achievement for even these ETFs to make it into the market. I think what we're going to be continuing to discover as well, that now it's a different type of investment vehicle that people have the opportunity to look at as compared to just holding Bitcoin as a custodian themselves or relying on the custodial services of, say, a Coinbase or one of the others that are out there. But with this, it's just a wrapper for tracking against Bitcoin versus making sure that you're maybe holding for the long term.
Yeah, and I think also just putting this drop in perspective, right? It's certainly worth pointing out. It's trending on our site here at Yahoo Finance, a drop down to 40,000. And we've heard from a number of analysts, a number of strategists here in terms of those who closely track Bitcoin here, track crypto. That 40,000 is certainly an important psychological level. But remember, Bitcoin prices were just around 25,000 not too long ago, back in September. So we have had this massive run up in this hype and the excitement for the approval from the SEC, which we finally got, the markets finally got. We had been anticipating a somewhat of a sell the news type of event, which certainly seems to be playing out here in the market. So I think the question here for investors who may be interested in buying into these ETFs, some of these funds that are now available, or if you want to invest directly into Bitcoin, is when we could likely see some of that support. It looks like at least right now we are seeing some support at that 40,000 level, which I think will be crucial here for investors going forward. But you're right there, Brad. I think the other question is also, of these spot Bitcoin ETFs that got approved, how many are going to survive in the long run once some of this dust shakes out, once we start seeing the demand or lack thereof of some of these funds, and exactly what that then, the impact that that could then have on the market is certainly something to keep in mind as well.
And as that dust shakes out, do you see more of a movement or even some profit taking in those who are holding Bitcoin as a currency and point their attention perhaps towards Ethereum as well? I mean, if you're looking at underlying technology, sure, blockchain, the underlying technology, but also a consensus type system that Ethereum is based on, and then the possibility that we could see several Ethereum ETFs be put forward, that is more of a kind of recurrence of the same price action that could potentially be applied to Ethereum that we'd already seen in Bitcoin.
Yeah.
All your markets action straight ahead, everyone. Stay tuned. You're watching Yahoo Finance.
From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry. The company generated over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the Ticker takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix in Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while retaining its DVD rental service. Netflix stock fell to around $9 per share in November 2011 after the company revealed that it lost 800,000 subscribers in its third quarter. 2 years later, Netflix released House of Cards, the beginning of Netflix's original programming. In 2015, Netflix shares surged to an all-time high, over $100 per share. That was growth of 574% over the prior 5 years. In 2017, a study by PwC showed that the Netflix subscriber base was now equal to the number of cable TV subscribers, 73% of all U.S. households. 4 years later, Netflix launched its gaming platform Netflix Games, available on Android with 5 games at launch. The company also announced plans to expand its gaming service to iOS. In 2023, Netflix announced the wind down of DVD.com with its last shipment on September 29.
Are you still watching? Streaming giant Netflix is out with earnings on Tuesday. Investors appear largely optimistic about the company, even as growth has slowed the past year. But has Netflix done enough to assuage some of those worries with its original content push, crackdowns on passwords, and pivoting global strategy? Let's bring in Yahoo Finance's Ali Canal to give us more details. Hey, Ali.
Hey, well, if you ask analysts on Wall Street, they certainly would say yes. Bank of America recently said that Netflix has effectively won the streaming wars with its global scale, its reach. So the expectation here is that they ended 2023 on pretty solid footing. Now, if you take a look at some of those metrics to watch, revenue is expected to come in at $8.71 billion. That's according to Bloomberg consensus estimates, and is roughly on par with the guidance that the company gave a few months ago. Earnings per share, meanwhile, expected to come in at about $2.20. Now, similar to other reports here, the emphasis is going to continue to be on the impact of that password sharing crackdown, along with the ad-supported tier and recent price increases. Now, all of that is expected to accelerate revenue in 2024. We've already seen some pretty solid momentum on that ad front. The company's saying its ad tier now has 23 million monthly active users. That's up 8 million from a couple months ago. And Wells Fargo said that could translate to roughly 9 to 10 million new subscribers. So not too shabby, considering we know that the ad tier is a fairly new product. The company itself saying that it would be a really slow start until we saw some of that momentum pick up. But speaking of subscribers, that's another number to watch here. Netflix said last quarter that they added 8.8 million new subscribers. They expect similar trends in the fourth quarter. So if that happens, that means Netflix would have added 24 million subs for full year 2023. So overall, should be full steam ahead with this report.
Yeah, Ali, certainly a lot of strong numbers here that we're expecting. With so many people, though, maybe potentially opting for that ad tier that they now offer. They did, though, also raise prices. So I guess, what does that then all mean for the average amount of money that they're making per user for Netflix?
Yeah, so average revenue per member, otherwise known as ARM, you're going to hear that quite a bit on the earnings call and the earnings release. This is a number that Netflix wants to get to a solid spot. It's likely that we're going to see it continue to be weak in the fourth quarter, but that should start to pick up in 2024 as we reach a better balance between subscriber numbers and those price increases, likely settling between 5 to 6% in 2024. And margins, that's another big story here. The expectation is that we should eventually see margins in the range of 22 to 23%, again, on those price hikes. But if we think about the streaming landscape overall, there is so much happening in this space. I think we're going to see more bundling. Gaming is a big area that Netflix has been focused on. So overall, I think it's going to be a pretty heated landscape in 2024, and Netflix is certainly at the top of that.
All right, and we will get those numbers later on this week. Ali, thanks so much.
Thank you.
All right, well, the Russell 2000 has taken a tumble since the start of the new year. Hotter than expected economic data has delayed some expectations for rate cuts. Let's get over to Yahoo Finance's Jared Blicker, who's been tracking this downward move that we've seen, Jared.
Yes, Russell 2000 actually outperforming today, but you are absolutely right. It has taken a tumble this year. And let me just show you the global heat map here for our indices. At the top of the pack here, this is year to date, is the Nikkei. That's over in Japan. 225 is up 9%. Then we have Malaysia up 2.5%. Then we get to the US. The Nasdaq Composite up 2.4%. But guess what? Small caps here stuck in the red here, up, down about 2.2%. And I can show you the big difference between large caps and small caps, illustrated with the Nasdaq 100 versus the Russell 2000. This is over the last 2 months, and I'm using this time period because there was a big spurt. This blue line right here, cyan, is a Russell 2000, and this was all on the back of perceived and hope for interest rate cuts, which are now disappearing. And this tumble that we've seen in the new year, well, a lot of that has to do with the fact that there are fewer rate cuts getting priced in. And in fact, the odds for a March rate hike have dropped from over 80% to less than 50%. So we can see that we've had some outperformance in the past by the Russell 2000 there, but over the last year, check this out, you can see the Nasdaq 100 is just far and away the big winner here, and in fact is at record highs, while the Russell 2000 is struggling to break out of a multi-year trading range. In fact, let me show you. I'm going to show you the last 2 years here. All of this chop here has been very frustrating for investors, but you can see we recently just barely broke out, then we dipped back below again, so that was a false breakout. That was kind of a bear trap for traders. But I will say this, even though the long-term price action is very much sideways, check out over the last 3 months, and I'm going to put a line chart on here. We can see it stair-stepping higher. We can see this over the last 6 months as well. Here's that stair-step higher, and we're simply in a minor retracement. So I think the odds are actually pretty good that small caps do break out of this multi-year trend change, sideways market, but that remains to be seen, and we'll have to see what catalyst that can bring. Unless there are renewed hopes for interest rate cuts this year, might not happen.
Yeah, really interesting insights and breakdown there, Jared, especially as small caps coming into the start of the year were one of the favorites that we've heard from chief investment strategists here on our air. Jared, appreciate you tracking this. Coming up, everyone, we're going to dig into the investment play in China after the not so strong economic data over the past week. That's after the break.
Chinese stocks under pressure once again today. Worries over the region stalling recovery. And taking a look at the Hong Kong's Hang Seng Index approaching the lowest close that we've seen since 2019. Let's put this all in perspective. For that, we want to bring in Shahzad Kazi. He's China Beige Book's International Managing Director. And Shahzad, it's great to have you here on set with us. So we got the disappointing data out last week. We've seen that reflected in the recent market moves. The number of U.S. listed Chinese names under pressure once again today. What does that then look like going forward for investors? Are we going to continue to see this type of pressure surrounding a lot of this uncertainty?
Yeah, I think the first point to be made is that China's economic recovery, disappointing as it was over 2023, has come to an end. And markets are seeing this and markets are panicking. Now, the second question is, does Beijing step in with stimulus? And I think the answer for markets to understand is there will be stimulus, but it won't be big enough to save the stock market necessarily, or more importantly, to really juice investor returns. This is going to be about stabilizing the property market and putting a floor under growth.
Is what we've seen in China insulated, or is there some kind of overflow impact that you're also tracking right now?
Well, largely right now, this is insulated, right? As you look abroad, the good news for China is that international demand really didn't flag as much as people feared, so the manufacturing sector held up. And of course, internally, the commodity sector has actually done quite well, steel, copper, and that sort of thing.
And when you take a look to, you mentioned the fact that the stimulus that we could get not nearly enough to maybe what investors want, what shareholders want to play out within the sector. When we talk about some of that further pressure, then is the worst then not yet behind us? And when we take into account what that could mean then for investors, how bad could it get?
Yeah, look, I think growth in 2024 is actually going to be slower than what we got in 2023. And markets will not like that. So this will increasingly become about, this is more of a defensive play. And of course, what we need to understand is how soon can the property market be stabilized? Because right now prices are crashing, sales are down massively, the values of homes are just coming down month after month, quarter after quarter.
What's the best way to really encapsulate the sentiment or the tenor around the Chinese consumer right now, as investors would want to be tracking some of their own portfolio plays within the region?
Yeah, Chinese consumers actually showed up over the course of last summer. There was some revenge travel, there was some revenge spending in parts of the luxury market and so forth, but that is all gone. I think the overall wealth destruction that you've seen happen in the country over the last couple of years, Chinese consumers are now taking a step back. They need a broader recovery. They need to see the labor market getting better, the hiring numbers to get better before I think their confidence really returns.
And Shahzad, also for investors out there who maybe don't have exposure directly to China, but there is an impact when you talk about the impact that this could have on U.S. companies, given the trade relationship between the U.S. and China, although the relationship has been a bit strained here in recent years. In terms of the impact that could then have on U.S. companies, on global companies, what does that look like?
Yeah, again, we've got some bad news potentially ahead, right? Because if you're dependent on Chinese travel and tourism, or you're in the gaming industry, or you're selling into China, not only do you have very severe domestic competition, but now you have an overall market that has been slowing and doesn't look like it's going to be picking up massively anytime soon.
Geopolitically, I mean, we're here in 2024. We know that there's going to be a ton of talk about, and from candidates, about international relations and where they're willing to delve further into relations with certain countries and where they're perhaps separating ties. And that could vary a lot. How do business leaders need to be anticipating where those ties are going to perhaps net out by the end of these elections?
Yeah, look, I mean, geopolitical risk is just rising. Political risk within China is rising too, but from our angle over here, as we get into the election season, you are most likely going to get a candidate, Trump, who is going to be much more aggressive sounding on China than he was the first time around. That's going to put pressure on President Biden and his team to look like they're very serious about China too. So investors, corporate decision makers, they're about to start getting rattled a little bit here.
Do you expect any change?
I don't know how much.
In the White House?
If we get a Trump presidency, I think we're going to see a lot of aggressive maneuvers on the China front. They are getting ready to make massive revisions, talking about things like getting rid of China's permanent normal trading relation status, for example.
Shahzad, always a pleasure to get some of your insights here. Shahzad Kazi, who is the China Beige Book International Managing Director. Thanks so much. And everyone, stay tuned. We've got all your markets action ahead. You're watching Yahoo Finance.
From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry. The company generated over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the Ticker takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix in Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while retaining its DVD rental service. Netflix stock fell to around $9 per share in November 2011 after the company revealed that it lost 800,000 subscribers in its third quarter. 2 years later, Netflix released House of Cards, the beginning of Netflix's original programming. In 2015, Netflix shares surged to an all-time high, over $100 per share. That was growth of 574% over the prior 5 years. In 2017, a study by PwC showed that the Netflix subscriber base was now equal to the number of cable TV subscribers, 73% of all U.S. households. 4 years later, Netflix launched its gaming platform Netflix Games, available on Android with 5 games at launch. The company also announced plans to expand its gaming service to iOS. In 2023, Netflix announced the wind down of DVD.com with its last shipment on September 29.
Amer Sports is gearing up to IPO and is seeking up to $1.8 billion. The Wilson tennis racket maker is planning to sell 100 million shares at $16 to $18. That's the range that they've announced thus far. This would be one of the year's first major IPOs, a unicorn valued company that would make its way into the public market here. And of course, the parent company of some of those storied brands, Solomon, Wilson, Arc'teryx, Louisville Slugger. My goodness. So you've got some brands that are certainly known at the household level. It's really interesting the timing that they're going public as well, potentially here, as there's this report that actually just came out from HSBC Global Research looking at global sporting goods. And one of the things that they cited within their own research, the first half of this year is probably going to be dented by a muted consumer demand in the West, elevated inventories in the U.S., and then likely slow recovery in China. But the second half they're anticipating should be a little better.
Yeah, I think the timing of this is very interesting given the fact that this is such a consumer-facing company, very reliant, obviously, on consumer spending, giving the brands that is underneath their umbrella. So something that investors need to keep in mind. But also, I think more broadly, beyond this debut specifically, it's really what this is going to tell us about the IPO market and maybe that bounce back that we have been waiting for quite some time. Because when you take a look at 2023's numbers, this is from Renaissance Capital here, we did see a bit of a rebound, 108 IPOs, raising a combined $19.4 billion. Yes, a massive improvement when you compare it to 2022, but historically speaking, still a relatively sluggish year. And the fact that rates are still high, the fact that the Fed may delay any potential rate cuts here further out than what the market had initially been anticipating, that of course has the potential to delay some of this deal-making activity. So if in fact we do see a public debut and a successful one at that, whether or not that then that reignites or reinvigorates the IPO market, it's going to be something that investors are going to keep in mind.
LL Cool J once said, don't call it a comeback. You can call this one a comeback. It was publicly listed before they were taken private. That was on the Nasdaq Helsinki before they were ultimately taken private by China-based Antisports.
And we will see whether or not the comeback is successful. All right, let's do a quick check of the markets here before we let you go. Again, they're still green across the screen. You got the Dow up 174. That's all from us today. Rochelle Kufo and Akiko Fujita have you for the next hour.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo alongside Akiko Fujita. Here's what we're watching this morning. An AI-fueled surge in tech shares has helped pull stocks out of their lackluster start to 2024. And markets aren't showing any signs of slowing down today as the climbs continue.
And BYD making its move into the luxury market after recently overtaking Tesla as the global leader in EV sales. The Chinese car maker is unveiling a new Lamborghini-like model with a $150,000 price tag.
Plus, tax season is upon us, of course. How retirees can set themselves up to save this year despite a possibly steeper bill.
But first, let's take a look at the markets. 90 minutes into the trading day, we are seeing green arrows across the board with the Dow and S&P 500 hitting fresh records in this session here, really extending that tech-fueled rally that we saw last week. The Dow up 158 points, the S&P 500 up roughly 11, and the Nasdaq up 39 points. Let's take a look at where Treasury markets are trading today. Yields all lower on the shorter end as well as the longer end. The 5-year right above that 4% level, the 10-year yield at 4.08 and the 30-year yield at 4.3%. Rochelle.
Well, of course, we have a big week ahead of us with key inflation data out ahead of the first Fed meeting of the year, as well as company results on deck as well. Now, investors will be watching all of this information closely as they try to maintain the momentum in this current market. Now, I think investors should be focused on earnings this week. We have some big results from companies across multiple sectors, including United Airlines, Netflix, Tesla, Intel, and Amex. So just to give a quick roundup here, we're going to see United Airlines reporting after the bell today. We'll get a bit more clarity, hopefully, about the health of the industry. The street was a little bit unsettled after Delta reported their profit outlook was below its long-term target. So a look at that, plus, of course, on the heels of the JetBlue-Spirit merger falling apart because of that court hearing. Tuesday, we have Netflix, of course, the streaming king. We'll get a closer look at some of those valuations, see if they're justified. Of course, they have been cutting costs on content and upping some of those third-party licensing deals. So we'll see how that's affecting margins. And of course, Wednesday, Tesla. We'll hear possibly from Musk. But we'll hear from Tesla on that earnings call, especially after he'd put that announcement out there calling for 25% voting control. He wants to become a leader in AI and robotics, wants that voting control to do that. And of course, eyeing those margins after those price cuts on some models in China and Europe, as well as some of these deliveries we'll be watching. And of course, the broader story on EV demand. Thursday, we have Intel. We'll see how much of that enthusiasm over AI is already baked into valuations right now. This is a big tech bellwether coming on the heels of Taiwan Semiconductor with solid earnings and a bullish forecast. And of course, on Friday, we have Amex, a Warren Buffett favorite, a real pulse on the consumer there. Keeping an eye on what we see with credit card delinquencies. Just on January 16th, they reported that it had remained steady at 1.4% in December and is still down from 2019. So a real overview, but get a bit of a taste of everything. These were just the 5 I picked. There's so many more, obviously.
Yeah, I mean, certainly going to be a big focus as we get into the heart of earnings season. JPM putting out a note today saying that there's likely to be a deceleration in the momentum for Q4 earnings. Corporate profitability under a bit of pressure here. They've highlighted a number of sectors, semis, autos, and banks. But a few things they've noted here. What to me, it's interesting. Last week, we spent, Rochelle, the week talking about the big banks. JP Morgan saying that those beats aren't necessarily being rewarded so far. So all those names you mentioned that are reporting this week, certainly one of those things to be looking out for. I'm going to be watching economic data really closely. You know, so much of what we've been seeing in the markets really fueled by this expectation of anywhere from 5 to 6 rate cuts. We've got the Fed's preferred inflation gauge, PCE, coming out on Friday. That is going to be key here, not just for setting the expectation for this upcoming meeting, because there is an expectation that not much is going to change, but it is about March. That's the next marker here, because the market has run up ahead with the expectation there could be a rate cut on the table. But Rochelle, when you look at some of the economic data that's come out so far, CPI already out earlier this month, core CPI, core inflation, which is what Fed wants to look at, much stickier than expected. And of course, even if you look at where the labor market is, we have seen surprising resilience there. So it will be interesting to see how this all plays out.
Indeed, and we know the Fed said that they didn't want to jump the gun, start cutting rates before the job was actually done. So we know they'll be keeping a close eye on that data and perhaps not jumping the gun just on a month-to-month data, but really taking that holistic view of a downtrend in inflation that they're hoping to see.
Yeah, we've really seen Fed officials sort of push back against the market expectation. Well, stocks continue their climb today as the AI euphoria that started last week spreads. We have big tech results out this week, and we'll be watching the impact they have on the market. Joining us now is Veronica Willis, Wells Fargo Investment Institute investment strategy analyst. Good to talk to you today. What's the one nugget you're watching going into what is a very packed earnings week?
I think what we're going to be looking for today are, we're still early in that earnings season, so there's not a really good trend in what's happening with earnings. And so seeing, how many companies are beating those expectations, how many are meeting expectations, and who's falling short. Are those companies that have really driven the rally, are those the same companies that are going to be beating expectations? And if so, is that going to make this rally more sustainable?
And so, Veronica, we're seeing a lot of people wondering, is now the time to buy the dip, or is there another one to come? Because this rally, people are going to be wondering if these valuations, really make sense once they pass through some of this earnings data. What are your thoughts there?
I think there's still potential for volatility here, so it's not too late to wait for a dip to get into the market, and it's certainly not too late to get into the market now if you know that you're going to be investing for the long term. There are still some uncertainties ahead, especially you all mentioned earlier in the program, the market's expecting, 5 to 6 rate cuts. That might be a little bit too aggressive. So if the Fed doesn't comply with that, that's going to be a source of volatility for the market. So there might be kind of a dip and an opportunity there to reinvest.
Veronica, when you talk about the dip, well, where are the opportunities you're looking at right now? Any particular sectors that you think are really good value?
Yeah, right now we're focused on some of those sectors that have a little bit more defensive characteristics. So we like energy, we like healthcare, we like industrials, and we like materials. We're expecting a bit of a slowdown in the first half of this year. So we think those 4 sectors are going to be, best positioned to insulate portfolios during volatility and during a slowdown before eventually moving to be more cyclical later in the year.
And also, you're seeing investors wanting to chase those yields, wanting to chase what they're seeing with big tech. You mentioned some of these defensive sectors here. What will be their turnaround point? Because they were already beaten up pretty severely last year.
Yeah, I think the economic conditions have been a lot more resilient than I think we were expecting. And so some of those defensive types of sectors suffered while the economy was still doing really great. We're going to get that advanced reading of the fourth quarter GDP later this week. Expectations are calling for that growth to still come in good, but definitely to be slower than what we saw for third quarter last year. So we're already starting to see some of that slowdown of the economic growth. And I think once the Fed kind of makes clear what their path is when it comes to the timing of any potential rate cuts, there might be this aha moment for the markets where those more defensive types of sectors will really have their moment to shine.
Veronica, what's the base case you're operating under in your investment when you talk about the timing for the Fed? Are you expecting a rate cut come March?
I think March is a little bit too early. Even May might be a little bit too early. So thinking, in the summer, maybe in the second half of the year, that might be when the Fed actually starts to cut rates. The economy is held in okay, and a lot of the policymakers have spoken about being comfortable with where rates are because the economy has so far been able to withstand it.
We'll certainly continue to track that. Appreciate you joining us this morning. Veronica Willis, Wells Fargo Investment Institute Investment Strategy Analyst. Thank you so much. All right, now let's take a look at some of our trending tickers. We have our eyes on the chip stocks today. Starting with ASML, the company getting a boost from Bernstein, saying it is, quote, attractively priced compared to its competitors. An analyst at the firm upgraded ASML stock to buy from neutral, saying it's likely to continue seeing strong earnings per share growth through 2025. Now, that optimism pushing the stock to a 2-year high, allowing it to reclaim its position of Europe's third biggest listed company. So this is an interesting one here because a lot of people were wondering how much room to run some of these companies had, especially as we've talked about that upgrade cycle. And they noted more likely to see that upgrade cycle kicking in 2025. So some optimism there. Do you think that's well-founded?
Well, I mean, I wouldn't necessarily make an analyst call here, but with ASML, we're talking specifically about the machines that produce these advanced chips. So you could argue they're well positioned there in what is increasingly a crowded field in the chip making space. ASML, of course, one of those names that we've talked a lot about in terms of the context of this tension that's been playing out globally on chips between the U.S. and China, too. So probably a welcome sign for the company to be able to get this kind of upgrade on the fundamentals at a time, which is something they can sort of control at a time when we've been talking so much about the geopolitical climate around this space. Let's talk about AMD shares. They are sinking as an analyst at Northland Capital Markets downgrades the stock to market perform, saying that AI is really big, but it's not as big as investors are thinking. This is one of those stocks that has seen a big run up on the back end of the expectation of how big AI can be. The stock up more than 12% a year to date. But, as we've been saying, Rochelle, over the last few quarters, it really is about show me for investors right now, specifically as it relates to AI chips. But you could argue, the AMD competes on the full spectrum for artificial intelligence. It's not just about devices. It is also about the cloud and everything in between. So sure, NVIDIA is the name that investors continue to hone in on, but AMD certainly well positioned there to be able to compete on that front.
It's true. And something else to keep in mind in that space, you saw a lot of stockpiling, especially among Chinese companies, as they saw that door closing as we get more pressure from the Biden administration and the CHIPS Act as well. So that's another factor to keep an eye on in the chip space. Well, staying in that space, looking at shares of Super Microcomputer extending gains after hitting a record high on Friday. The company forecasting that artificial intelligence demand will push quarterly results well above analyst estimates. Now, supercomputer is an interesting one because there aren't too many semis that can say they actually outpaced NVIDIA's growth over the past year, but they're one of the few that over the last year and still currently year to date outpacing NVIDIA. It's one of those companies that doesn't get talked about much, very well priced at the moment, and really is a company that makes servers that have this cutting edge graphic processing unit technology, or for GPUs, that creates the AI model. So it's a beneficiary of the run up that we've seen with NVIDIA, but more attractively priced, obviously, than those who missed out on the big rush with NVIDIA, Akiko.
Yeah, and getting caught up with that AI-fueled rally that we have seen over the last week. That stock up 1.5% right now, roughly, in the session.
Indeed. Well, we still have all your markets action ahead, so stay tuned. You're watching Yahoo Finance. Use it or lose it. At least that's what you're probably thinking about the money in your flexible spending account or your FSA. Now, FSA plans give workers the benefit to save money on health expenses pre-tax, but these accounts do have restrictions and, of course, deadlines. Now, typically, FSA users need to use their money by December 31st, but depending on which healthcare FSA plan you have, your employer can offer you a grace period. And for those who have that extra 2.5-month extension, be mindful that March 15th deadline is just around the corner. Well, joining us now is Lawrence Sprung, Midland Financial founder and author of Financial Planning Made Personal. So, Lawrence, good to see you again. So give people what they need to know here. How can FSA users best maximize the potential of their account, and what are the deadlines? What should they do between now and the deadlines?
Yeah, it's great to see you as well, Rochelle. And yes, they are in crunch time right now. Essentially, employers can offer typically one of two options. They can either give you the extra 2.5 months, so until March 15th, to utilize those funds, or they can also offer you the option to potentially roll over a portion of those unused funds. So if you were left with money and your employer lets you roll it over from 2023 to 2024, you could roll over a maximum of $610. So you're either faced with typically using it by March 15th or rolling over a maximum of $610. So it is important to take a look at those balances from last year and figure out a game plan on how to use what you need to use by the deadline.
And for those, Lawrence, that have some money still left over, I mean, give us a primer here again on what is FSA eligible.
Yeah, so there are thousands of things that are FSA eligible, and with an easy search, you could figure those out. But, let's say you're in a position where you have significant money left over in the account. Think about some of those high price or high ticket items that you might benefit from. So let's say massage can be FSA eligible. That could be a great way to take care of your wellness and utilize some of that FSA money. Maybe you haven't bought yourself a new pair of glasses in a long time, and those can be pricey. Or maybe you need to stock up on contacts for the year. Or maybe you haven't had a dental exam. These are all things that are healthcare related, FSA eligible, and then included, on top of that, there are thousands of products, including, aspirin, Advil, Tylenol, pain products, medicines, things like that are at, your normal retailers and pharmacies. Many of those are FSA eligible. You could go on and do a search and definitely use those monies very easily.
And Lawrence, sometimes it can be hard when you're sort of picking out your benefits for the year. You see HSA, you see FSA pop up. Talk about the difference between those, and not just what you can spend with them, but also your ability to perhaps borrow against them.
Yeah, so your HSA, first of all, you have to have a high deductible healthcare plan to be eligible for an HSA or a health savings account. So if you have that, it's a way for you to put away pre-tax money that can be used for co-pays, very similar things to an FSA. The benefit of the FSA is you do not need a high deductible savings account. So if your employer offers it, everybody is eligible for an FSA, and it allows you to put monies away pre-tax for very similar things to the HSA, but you also have that use it or lose it functionality in the FSA, or the ability to roll it over from 1 year to the next, or that extra 2.5 months. The HSA is something that allows you to continue to roll over those monies and grow over time. Neither one of them can you borrow against, but you can use as a vehicle to pay for those out-of-pocket health expenses utilizing pre-tax money.
Lawrence Sprung, Midland Financial, joining us there. Some good takeaways, and author of Financial Planning Made Personal. Thanks so much for joining us today.
Thank you.
Well, some calculations for pre-orders of Apple's Vision Pro headset are in, with one analyst estimating between 160 to 180,000 were sold over the weekend. The device went on sale at 8 a.m. Eastern Time on Friday. It's set to start delivering in early March. Let's bring in our tech guru, Yahoo Finance's Dan Halley. Dan, that $3,500 price tag, turns out people are willing to shell it out.
Yeah, I think a lot of early adopters, a lot of the Apple fans are probably the ones that are going in on this. Probably a lot of developers as well, folks that just want to kind of get in on this. Obviously, the AR, VR market has been, ups and downs. There was the original phase where people were just, over enthused about it, and then it kind of started to plateau a little bit. Meta is the market leader with their Quest line of products. And there's been various reports saying that, after a few weeks, people don't really pick them up as much anymore, or they just kind of sit in a box. So it'll be interesting to see what happens here with the Vision Pro and these people going out and buying one. I did a mock purchase, $3,500, a little rich for my blood at this point. But, it showed that it would be delivered sometime in mid to late February. So obviously the dates are being pushed back here on what people can get as far as the product itself goes. And there's also been reports that some app developers aren't going to be putting their apps on the Vision Pro out of the gate. I believe, Netflix being one of them, Spotify, some of the companies that haven't necessarily had the best relationship with Apple publicly as far as the app stores go. And so, those aren't going to be available when it comes to the Vision Pro itself. But I guess that's not stopping people from going out and buying it. I mean, I got to try it back in June at WWDC. I really was impressed compared to what I'd seen from other headsets, whether that's the Quest 3 or anything else, the prior generation PlayStation VR I had used. So it is truly impressive. I think that the main question here is, what are you going to use it with, right? I keep kind of harping on this. I have a 65-inch OLED TV. I love it. It looks great. It's 4K. Everything looks awesome. I don't know if I need and I'm a dork when it comes to screens, right? I'm constantly pestering my wife. What about this TV? Shouldn't we get one of these? So it's not like I don't like this stuff, but I just, I think for me, I'm still trying to get the sense of where's the killer app that makes this worth $3,500 for me.
And you raise a good point, especially when you talk about sort of the developer relations, some of the apps that aren't going to be on it, and then you couple that with the price tag and the what am I even going to use this for factor. How do you think Apple gets this beyond the early adopters to have your everyday person really be interested in this product?
I think what it comes down to is, the usefulness of it. When the initial reviews start coming out and the people giving their own input on what it's like to own them, that I think is when we're really going to start to see how Apple pushes this forward. Don't forget, when the Apple Watch came out, it didn't get great reviews. They were, decent. People were like, well, why do I need this watch? It's expensive. Fast forward to now, and it's the best-selling smartwatch in the world, right? So, I mean, same thing with the AirPods. People were making fun of them when they first came out. And if you walk around anywhere, people have AirPods in all over the place. There's knockoffs that try to look like the AirPods because the AirPods are so popular. So, it's not that this isn't a product that has potential. I think right now, people are still trying to figure out what they're going to use it for, what they need it for, just like we saw with those others, with the Apple Watch and the AirPods. Those have more of a right up in your face, this is why I want to use it. But it took a while for the Apple Watch to really kind of get honed in on the health side of things. I think that might be what we see with the Vision Pro, where it kind of comes out, there's this general idea of what it may be used for, and then it really gets honed in and people start saying, well, I want to buy it. I think the price tag is still a little rich for a lot of folks. They'll have to release a lower price option, or maybe they will lower the price overall. But I think right now it's still very much a kind of wait and see for where we go with this.
Yeah, well, as one of our guests said, Apple Vision Pro suggests there may be a cheaper alternative coming. But as you've noted, Dan, always a challenge with first generation of products, but we'll be watching to see how that demand picks up. Thanks so much. Well, coming up, tax season is upon us, but it may come with a steeper bill. We're going to discuss on the other side. We'll be right back. It is time for our chart of the day. Tax season is upon us, and we're taking a look at tax debt. 18.6 million individual taxpayers owed the IRS $316 billion in overdue taxes at the end of 2022. But the breakdown varied, with about 5 million taxpayers owing under $1,000 to the IRS and almost 6.3 million owing between $1,000 and $5,000. Rochelle, moral of the story is pay your taxes. But this is an interesting story out of the Wall Street Journal today, which points to some people who haven't paid since 2013, those who maybe got caught up during the pandemic, sort of still trying to clear the pipeline. But an important reminder here in the piece, which is something we've talked about before, the Inflation Reduction Act, adding for more IRS officers here, really going after, at least in the story, high wealth individuals, high income, high wealth individuals. I don't know. I am not a person who starts my taxes early, but I do make sure to pay it if I owe.
I mean, I usually would put mine in at about February, because sometimes there are some sort of last minute changes. Like I know when it comes to like the child tax credit that they were still sort of working out. And I saw one of an article saying, don't pay your taxes too early in case there are a few of these things still lingering. But yes, they did highlight in the article that a lot of these IRS collection efforts were actually paused during the pandemic, and they didn't have the manpower to work through it. So I think people sort of breathed a sigh of relief and thought, oh, maybe I'm doing all right. But they're like, no, the tax man cometh. We're up and running. And so perhaps expect a smaller refund this year as well. And of course, you don't just have to wait for some scary letter to come in the mail. You can always negotiate with the IRS, or once you get sort of check in on the IRS website, try and pay it up early and, to at least take some of that stress off. But, difficult times. Now, if you haven't paid since 2013, I mean, that's a different story. But at least for the recent ones,
I think a psychological game people play, right? Yes. If I don't deal with it, it'll go away. And that seems to be what is playing out, at least according to this piece. My question to you, Rochelle, is do you do your own taxes or do you get an accountant?
So I do mine through one of the digital tax services, because I used to go sort of in person, like old school accountant, and then they messed me up one year, and then I was like, oh, I can't do this again. At least with a lot of the newer ones, there's, a lot more like legal protection in case you get audited. And it's also easier to transfer it if you go from sort of one system to another. There's a lot more consistency there. What about you?
You are a lot more organized than I am. I just hand off all my paperwork to my accountant, and I sign off on everything that's due at the end.
Well, I mean, it seems to be working out, so that can't be too bad. Well, we're going to stay with taxes. A potentially steeper tax bill could be on the horizon for some people this year. Now, with Social Security recipients receiving a higher cost of living adjustment in 2023, that extra income could make their benefits taxable. Here with ways retirees can save this tax season is Yahoo Finance's Kerry Hannon. Kerry, good to see you. So what do retirees need to know?
Well, great to see you. So in addition to that bump up in the cost of living adjustment, retirees also in their non-retirement accounts saw some boost there as well. You figure the S&P 500 was up like, 24% or something last year. So in capital gains and dividends, they saw a little more juicier income coming in. But there are a couple of things there's still time to do. There's three basic things. The first thing is, and this is absolutely true, many retirees continue to work part-time or as a consultant. If you're doing that, you can contribute to an individual retirement account. And if you have up until April 15th, if you're 50 and over, you can put in $7,500, lock that off your gross income. And that's a great savings right there if you can get to that. The second thing is a health savings account. If you haven't started taking Medicare yet and you're in a high deductible medical plan, if you're over 55 and over, you can set aside $4,850 this year in that account by April 15th. What I love about these, Rochelle, is it's a triple tax advantage. You don't pay tax going in. The money grows tax-free in the account. And when you take it out for medical expenses that are approved medical expenses, it's not taxed in either. So it's a really great asset if you can shift money over there this year. The third thing is itemize. You might want to itemize. It depends on your situation, but the standard deduction is $27,500 if you're married filing jointly. And I think it's $13,500 for single filers. Now, if you've had a big medical bill, come on, you can easily exceed that. So it might be worth your time to talk to your accountant a little bit and find out if, in fact, your medical expenses bump you up over so it makes sense to itemize this year. The final thing is a lot of people forget about there's an extra standard deduction if you're 65 and over. Now, it's a smidge. I mean, really, it's not a huge amount. It ranges from $1,500 to $1,850, depending on your filing situation. But it's certainly worth a consideration. So I encourage everyone really to really scrutinize, where can I get a little bit off the top here? Because last year, in fact, was pretty good for some retirees.
And Kerry, some retirees sort of stick their heads in the sand and sort of stick things on autopilot. What's the biggest mistake they can make in this time so that, they don't, in case they end up missing out on a bunch of money when they don't have to?
Yeah, I think you really need to be proactive. And I love your discussion earlier about, do you work with an accountant or do you do it yourself? And if you choose to do it yourself, stay on top of these things because there are ways. And then I also think it's really important to look ahead. I think retirees this coming, for next year's tax season are going to find that those who are already taking their required minimum distributions from their retirement accounts are going to have bigger distributions next year. I mean, during this tax year, right, for 2024. So for next tax year, I'm confusing everyone, but 2025's tax bill may be a bit bigger. So right now, start looking at what you might be able to get some breaks during this year so that you will be in a better position next tax year.
Always have to plan ahead. Appreciate you always breaking that down for us. Our very own Kerry Hannon. Thank you.
Thank you.
All right, coming up, is BYD trying to compete with Lamborghini? France Subramanian has the latest on their reported new luxury vehicle on the other side of this break.
From its subscription concept to the rise of streaming, Netflix has built itself into a force in the entertainment industry. The company generated over $32 billion in revenue in 2023, including over 247 million subscribers worldwide. Beyond the Ticker takes a deep dive into the company's biggest moments. In 1997, Mark Randolph and Reed Hastings founded Netflix in Scotts Valley, California. 3 years later, Netflix launched its monthly subscription concept. DVD rentals were mailed to customers, along with prepaid return envelopes. Later that year, Netflix was almost sold to Blockbuster for $50 million, but Blockbuster declined the offer. In 2002, Netflix launched its IPO, selling 5.5 million shares at $15 each. It brought in $82.5 million. 5 years later, Netflix announced that it would debut streaming video while retaining its DVD rental service. Netflix stock fell to around $9 per share in November 2011 after the company revealed that it lost 800,000 subscribers in its third quarter. 2 years later, Netflix released House of Cards, the beginning of Netflix's original programming. In 2015, Netflix shares surged to an all-time high, over $100 per share. That was growth of 574% over the prior 5 years. In 2017, a study by PwC showed that the Netflix subscriber base was now equal to the number of cable TV subscribers, 73% of all U.S. households. 4 years later, Netflix launched its gaming platform Netflix Games, available on Android with 5 games at launch. The company also announced plans to expand its gaming service to iOS. In 2023, Netflix announced the wind down of DVD.com with its last shipment on September 29.
Well, in the market for a $150,000 electric supercar? Well, BYD's new car may be for you. The U9, released under the Yangwang brand, is hitting the market this year. To break this down for us, we've got Yahoo Finance's Praz Subramanian. Praz, of course, BYD surpassed Tesla as the largest EV maker in terms of sales. That was on the lower end. Talk to me about the strategy competing on the higher end.
Yeah, so BYD, right, in Q4 passing Tesla there with that overall EV sales sort of metric there. But yeah, with this, the Yangwang U9, think of it as Yangwang being like BYD's Lexus in terms of BYD being a Toyota right there. Premium luxury brand there. The U9 there, look the Lamborghini looks, sports car, super sports car there. But the car will have also 1,000 horsepower, so there's no slouch. And it only costs, like you said, $150,000. There are a couple other electric EV supercars out there, Lotus Evija, the Rimac Nevera, among others. But those are several million apiece. This car is actually a relative deal here. We haven't seen Lamborghini or Ferrari put out their full EV supercars just quite yet. So BYD with the Yangwang brand will have that out there right now. And as all the fun aside, this U9 is basically a halo car for BYD. Like as you mentioned, as it takes on Tesla and surpasses them for total EV sales globally.
If at some point they enter the U.S. market, that's gonna be tough. That's gorgeous.
I'm waiting.
I appreciate you always break. I know, right? Because not only for the cheaper ones, but some of these, these incredible supercars here.
I mean, that's 911 pricing there, $150,000. That's a pretty. I mean, I could see that car doing quite well here if it actually comes out.
Well, we shall see. Thanks to our very own car connoisseur, Praz Subramanian. Thanks so much.
Thank you.
Well, the travel and tourism industry is expected to reach over $927 billion this year. That's according to Statista. And companies are looking to cash in, of course. So Get Your Guide, a digital platform to book travel experiences, is launching its first national marketing campaign in North America, focusing on the US. To tell us more about the growth of the brand, Tao Tao, Get Your Guide co-founder and COO, is here. Thank you for joining us this morning. So talk about getting your name out here in the US, because obviously a lot of people know your platform in Europe.
Yeah, good morning, and thank you so much for having me. Yes, indeed. So we think very much the trend in the last couple of decades that experiences are bought more than things is become abundantly clear. And what we now think is that this is the prime time to build a household brand for travel experiences. So as you said, we've built our legacy over the last decade in Europe, where we've started. But now we're really taking this to the United States, where consumer demand for travel experiences is higher than ever. It's undisturbed by the economic uncertainty, and very much drives the passion and the diversity of people what they're seeking when they travel.
So how are you looking to position yourself in the U.S. market? We were talking about where Get Your Guide is in the travel space. Viator, a name that popped up as a potential competitor. And how are you looking at your offerings and how you kind of break through the crowd?
Yeah, that's a great question. I think it's worthwhile to start with the founding belief that we had when we started the company about 15 years ago. Our belief was very much that the future of travel will be guided. So when you think about going to a destination, that you don't just stumble upon random things to do, but that you have someone to guide you towards the things that are truly beneath the surface, that are unique, that are authentic. And it's this singular belief that drove us to build a pure play company. And so that is really the core differentiation that we've built. So it's not a travel company, because if you think about travel, travel isn't a passion. Nobody says, I love my non-reclining seat in an airline, or maybe the crappy hotel room, but to think about the sights and the nature and the food. And that is what we've built, a pure play company for travel experiences. And, we've been doing this for a decade, if you will, but really just getting started. And the unique selling point that we have is really that we have been doing this for more than a decade with a tremendous amount of focus.
And I want to ask you about some of your latest developments, your partnerships with Air India, and of course on the OpenAI platform, the GPT platform as well there. Who are you trying to target in terms of your audience, especially as you broaden out into North America?
Yeah, absolutely. The target audience that we target is very much what we call modern explorers. So modern explorers are customers who are curious, who are willing to explore, willing to learn, And really, you can find that segment of customers anywhere. And partnerships like the one we did with Air India, but many others in the US, like Amex, or Lonely Planet, really taps into this consumer segment that want to live for their passions. So if you think about our experience creators, the ones that deliver those experiences, those are a lot of small mom and pop stores really focus on creating and tailoring those bespoke type of experiences. And we try to match that against this overwhelming consumer demand that wants to live their passions when they travel.
Tal, the travel industry, always a good gauge of the broader macro environment, where the consumer sentiment is right now. What are you finding on your platform? Are consumers already planning ahead to the summer in the way that you saw last year with this revenge travel? Are you finding that they're turning a little more cautious?
So travel is extremely resilient, and we saw this already last year and this year as well. If you look at air capacity, it just keeps going up because people have this insatiable desire to travel. And when we look at our own data, so what we saw is in our surveys, 97% of Americans said they plan at least one leisure trip. And of everybody we surveyed, they said they would either maintain or increase their spending on travel experiences. So the resilience of the travel experience sector is something that we see that's very, very strong. It's number one. And the second part is where people go. So what we see is very interesting is, especially last year, Americans just came back really in droves into Europe and into major European hubs, as well as American hubs. And we see, especially for next year, that people are planning a lot of trips, especially to Central and South America, which is also why we're growing our footprint there with the Mexico office opening.
So if you're a travel company, an experience company out there, and you're looking to work with a platform like yours, one thing that they always look at is commissions. How competitive are you on commissions?
The way we think about our experience creators is how we can add value. So let's take you briefly to what experience creators exist. On one hand, you have really the independent creators and the small entrepreneurs with their mom and pop business trying to stand out against the large theme parks and attractions. And on the other hand, all the way up to the other side of the spectrum, you have iconic sites, iconic institutions, museum, theme parks. So the challenge that a lot of our experience creators ask is, yes, commission is a part of the equation, but the main part is, how do I really stand out? How do I really differentiate my offering? Because unlike in hotels, it's not just about a room where you sleep in, is it price A or price B? But people are asked the question, how should I spend my time in New York City, in Austin, Texas, or in Cancun? And so the question is, how do I stand out? And our main value that we can give is to drive insights to these experience creators, to tell them how they can stand out, how they can differentiate, and use technology to really bring the offering to the fore.
Okay, well, interesting to see you expand your footprint here in the U.S. Tao, Get Your Guide co-founder and COO. Good to talk to you today. Appreciate the time.
Thank you.
We've got all your markets action ahead. And we are taking to the skies with Adam Goldstein, Archer Aviation CEO, to discuss why you may consider investing in eVTOLs and what the company is doing to expand how we see transportation and climate tech. Well, Archer Aviation is flying high this morning with shares up more than 3% there after announcing their latest partnership with NASA, one that will focus on studying battery cells and use cases for space flight. This comes on the heels of another partnership Archer announced with Atlantic Aviation to build out more infrastructure to support eVTOL operations. Let's bring in Adam Goldstein, Archer Aviation CEO, to discuss more. And Adam, we should mention, by the way, for those who are not familiar, eVTOLs, electric vertical takeoff and landing aircrafts. Talk to me about this partnership with NASA. What does it ultimately mean in your efforts to expand adoption of eVTOLs?
Well, this is a really exciting partnership because NASA was actually where eVTOL technology was created. NASA was one of the first groups to figure out how to fly an airplane using multiple electric motors. So that's why this is really such a special partnership. But specifically, we're going to be working with NASA on applications that will help really show and validate the extreme safety that these vehicles have. We're starting with battery cells, where we will work together to validate the safety of the cells and really show the world the performance that these can have. But it's also really exciting because there's lessons that can be learned here and may even get potentially used in space.
So Adam, with that in mind then, what does the investor appetite look like for this technology, and especially as it's positioned against other climate tech?
So the category of electric vertical takeoff and landing aircraft to be used as air taxis has the potential to be absolutely huge. It's hard to say exactly how big, but I think everybody agrees that it's going to be quite large. And the reason is that these vehicles can be used across so many different applications. These vehicles can travel up to 100 miles. They can carry a pilot plus 4 passengers, or an equivalent 1,000 pounds of payload. And that just enables a lot of different use cases. And so the primary use case that we're focused on is moving people around. And that market has been estimated to be as big as trillions. And so there are an amazing amount of things that we can do, starting with moving passengers, but also expanding into cargo as well.
What does the infrastructure look like for that vision? I mean, how much of that has actually been built out?
So the good news is that we've built vehicles that will leverage the existing infrastructure that's out there. And so if you think about applications like a route that's an airport to a city center, there's already infrastructure that's there. So a trip that we've been working on with one of our partners, United Airlines, is a trip going from Manhattan to Newark Liberty International. So we focused on heliports that exist already in Manhattan, and then flying into the airport, Newark, which has existing infrastructure already built. So this same type of process can be applied across the thousands of general aviation airports that exist today, the thousands of heliports that exist today, which can enable our go-to-market in a much more efficient and a much larger scalable way than I think many people actually understand.
Adam, what's the timeline for this to come to market? When is it going to be commercially available?
The good news on the timeline is that the FAA has really put into place all the things that are necessary to get to market by the end of 2024, which will enable us to come to market in 2025. So we're in the final stages of the certification process, going through that with the regulator, the FAA here in the US, with the goal of launching in the US in 2025, and then ultimately internationally in 2026 and beyond.
And Adam, I want to ask about your C-suite here. Obviously, a lot of concerns when you think about flying, especially the news about Boeing. How are you prioritizing safety, and how is that reflected in your C-suite?
Yeah, that's a great question. So one of the key people that's helped really set the frameworks in place for how this industry will start was Billy Nolen, who was the former administrator at the FAA. So we recently hired Billy Nolen to be Archer's chief safety officer. Billy has decades of experience as a helicopter pilot, as a captain at several different airlines, and has spent a lot of time in critical safety positions. So he is very well qualified to understand how to implement a proper safety policy that can enable Archer and really the industry to be able to scale into becoming a mass market transportation solution.
Well, certainly excited to see where things go from here. Appreciate you taking the time to join us this morning. Adam Goldstein, Archer Aviation CEO. Thank you so much.
Thank you.
All right, well, let's get you a final check of the markets as we head into the noon hour. Still looking at green across the board, although off session highs, even though the Dow and the S&P did hit all-time new records earlier this morning. We're currently looking at the Dow up about 144 points, the S&P 500 up about 1/3%, and the tech-heavy Nasdaq there up about 0.5% on the day, or about 74 points. Well, that does it for now. I'm Rochelle Akuva alongside Akiko Fujita. We'll see you. Stay with us on Yahoo Finance.